economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Good morning and welcome to Bloomberg Markets. I'm Anna Edwards, live in London. Coming up, mounting recession fears casting a shadow over markets after its worst performance in over 3 decades. German unions warn the country's gas crisis could wipe out entire industries, and investors looking ahead to a big week of economic data, including the US payrolls report. Good morning, everybody. Let's have a quick check on these markets, shall we? We've got European equity markets moving a little bit higher this morning, up by 0.7% on the Stoxx 600. The FTSE 100 up by 1%. The CAC 40 up by 0.7%. And the German market, the Xetra DAX, up by just 0.1%. So we have a little bit of positivity coming through on European equity markets as US futures point lower, although we are without, of course, the US trading session. No US cash trading today. So we're without the US part of our trading contingent, but European stocks, as I mentioned, moving a little bit higher. A focus on bond markets. We have no treasuries cash trading, but we do have futures. We do have cash trading here in Europe as well. We see yields going higher broadly here in Europe, and you can see that on the Italian 10-year. We're selling fixed income products, we're buying stocks, and we see that the Italian 10-year yield there, 3.197 is the yield right now. Gas prices then up by 6%. Ongoing focus on what's going on in Germany. Renewed call for bailouts of Uniper. That's a big German utility business. The unions warning now about the extent of the impact that we're going to see on the German economy and various parts of the German economy from the potential of Russia to shut down flows of gas into Germany. We've seen a big reduction, but no shutdown as yet. And iron ore in focus. We see big drops in commodity prices. Now, growth concerns in the United States casting a shadow over Wall Street as economists race to downgrade outlooks.
Economists have begun to cut their top-down economic forecasts for GDP.
We're looking at an economy losing momentum faster than what we anticipated.
Input costs have risen substantially.
We've had the 2 biggest quarters of inventory build.
We're seeing demand destruction in some areas.
The consumer is on somewhat more fragile footing.
We're starting to see this economy slow.
We do expect the Fed to hike rates more aggressively.
Companies and consumers need to get ready.
Frankly, we think they can keep going.
There's a change in the underlying economy.
We did see some pretty notable downward revisions.
We just don't see how we don't get a recalibration here.
We expect more downgrades. We've seen some already. We expect more.
We're getting clear signs of slowing.
Some of the guests talking to Bloomberg then about their expectations for the global economy, the US economy in particular. Let's talk now to Gurpreet Gill, Goldman Sachs fixed income macro strategist, who joins us now. Gurpreet, very nice to have you with us. How much of a base case is recession in the US becoming? Or if it is not your base case, what are you still waiting for?
Yeah, it's definitely a big concern. We saw towards the end of the last quarter a magnified focus on recession risk. When we look at the data for G10 economies, including the US, we find that soft landings are more common when inflation expectations are anchored and when the private sector balance sheet is healthy. But they are less common when inflation is elevated, which necessitates aggressive monetary tightening. In today's cycle, we find that we see all 3 elements, and so it really underscores the uncertainty on the outlook. What we are focused on is evidence of inflation gravitating back towards target. There's 2 key things that we're focused on. One is what happens in the labor market. Do we see any signs of softening? Do we see a moderation in job openings? And then secondly, inflation expectations, for which commodity prices are particularly relevant.
Okay, and so where does that leave you on the, are you therefore saying that there won't be a recession? Are you coming down just about on that side of the argument, Gurpreet? Or tell me more about your thinking about whether we see a recession in the US.
Yeah, so our base case expectation is not for a recession. We do expect continued monetary tightening, but like Jay Powell acknowledged last week at the ECB conference in Sintra, a deceleration in growth is expected, and there is a hope that growth remains positive, but that is not guaranteed. And so you may well see a technical recession, but what really matters when you're thinking about the investment landscape and opportunities in fixed income sectors is the magnitude and sort of the characteristics of that recession.
Are you expecting to see any softening in the US labor market? Gurpreet, we've got payrolls data out later on this week, and I know for some people that's going to be a key area to watch.
Yeah, what's interesting is that central bank tightening is occurring against the backdrop that was already showing signs of a moderation in growth, particularly in the industrial sector. And we've now had this cost of living squeeze that's going to start to impact the services side of the economy. Yet central banks have now started to dial up hawkish rhetoric. And the Fed, for example, is expected to deliver another 75 basis points rate hike this month. We would say that what central banks are trying to engineer is a degree of softening in the labour market. They want to slow the labour market to the extent that companies shelve new hiring plans, but don't necessarily engage in large-scale layoffs. We'd say that there's so much uncertainty, we're going to have to monitor the data closely. The expectations for this year is for the unemployment rate to remain stable, but for the pace of job gains to moderate.
We have seen, talking of moderating, we have seen some energy prices moderating a little bit, at least since highs earlier on this year, Gurpreet. Are you seeing signs that those higher energy prices that we were talking about are actually, killing off themselves, if you like, or demand destruction? Are you seeing that coming through in any sectors?
Well, with the energy sector, I would say there is a long-term inflation story at play due to decarbonisation. So greening the economy is going to lift inflation through higher commodity prices, but also the magnitude of investment needed could lift aggregate demand and inflation. And then as it relates to fossil fuels, we've had years of structural undersupply. High fossil fuel prices are set to persist, given the global economy is still more than 80% powered by fossil fuels. Until that changes, that is going to be inflationary, and central bankers like ECB's President Lagarde acknowledged that last week. Where we do see signs of improvement in inflation is on the supply side issues front. And so supplier delivery times in the PMI data is starting to moderate. And in the hoped for soft landing scenario, goods prices start to come down due to normalizing demand, but also improvements in supply chains. And so it's encouraging to see that.
Yes, and we will see whether we get those, materially transpire then, Gurpreet, those improvements in supply chains. One thing that perhaps would alleviate that supply chain situation might be a bit more normalization in China. For some people, that's still a very long way off. In terms of that global growth story then, Gurpreet, what role would you expect China to play at this point?
Yeah, we do think that you have seen some positive signs in terms of China easing restrictions. And so China could be a source of positivity for the global economy in the second half of this year. We think we're kind of moving past that peak negative impulse from China. We don't expect any big bang in terms of the policy response and stimulus in China, given policymakers are focused on deleveraging more broadly. But we do expect there to be some easing in activity restrictions, which will support growth. Importantly, that helps to ease a lot of the supply chain issues that have been causing higher inflation in most advanced economies.
For some people, deglobalization is one of the effects of those supply chain issues, and post-pandemic, a lot of people thinking about it. And some refer to friendshoring, so putting production facilities in so-called friendly geographies. Gurpreet, is that going to be something that we substantially invest around, or is this something that will, yes, happen, but only at the margin?
We are definitely seeing that there is a rewiring of globalization as it relates to trade in goods. And so trade in goods peaked many years ago and it's now coming down. But from a globalization standpoint, trade in digital services and services is still globalized. But to your point, more localized production is a potential inflationary source, providing it's not coming more closer to home as a result of lower cost and technological innovation. So it's definitely going to be a theme in the years to come, particularly in the equity market to play for. I think for fixed income markets, one of the more thematic themes that we're focused on is decarbonisation. So to decarbonise the global economy, you need innovation, you need investment, and you need incentives. And that investment is going to be partially funded by green bonds. So the fixed income markets are going to be a very important source of funding for decarbonisation.
Yeah. A nice moment to mention a red headline we just had across the Bloomberg, Gurpreet, which said that the ECB is to tilt its corporate bond holdings to reflect climate risk. So that's on the corporate side of things. You were there referring to the sovereign debt side of things. Are we issuing enough green bonds? I saw some coverage over the weekend that suggested maybe we're not issuing enough of those products to meet climate change commitments.
There definitely is a more demand than there is supply of green bonds, and that has led to a premium at point of issue. But for investors, big picture, we would note that that premium doesn't necessarily translate into weakness in the secondary bond market. And more long-term, companies and countries that issue green bonds they tend to be more innovative and forward-looking. And so we think over time, you will start to see performance differentiation, and we are starting to see an increase in supply. It's worth noting that there's not yet any global standard on what constitutes a green activity or project that these green bonds finance. And so until we have that regulatory clarity, I think you might still have undersupply relative to demand.
We're going to hear from Christine Lagarde this week, Gurpreet, a little bit more detail on ECB thinking around rates, but also around this anti-fragmentation tool. What do you think the market is watching for?
Yeah, the market is expecting an announcement on that tool at this month's July meeting. There's still a lot of uncertainty around what sort of market conditions would necessitate its use. Would it be open-ended in nature? Also, all of the details of its makeup and whether, like I said, it's open-ended or for a fixed period of time, and also what requires its use. So I think markets are more focused on what does this mean for the policy rate outlook. Does the introduction of this tool allow for a steeper and a faster rate hiking path? I mean, that remains to be seen. One thing that was clear from Christine Lagarde last week is that she does believe we are in a structurally higher inflation environment as a result of structural themes like that rewiring of globalization, decarbonisation, but in Europe, also aging demographics, which shrinks the labour supply force.
Okay, Gurpreet, thanks so much. Good to speak to you. Gurpreet Gill of Goldman Sachs Asset Management. So thank you very much for being with us. Coming up on this special edition of Bloomberg Markets, special programming, of course, because it is July 4th. If you're celebrating Independence Day in the US or elsewhere, then I hope you have a good one. We are here, though, talking about markets globally. And don't miss, coming up on this program, don't let optimism among equity analysts fool you. Earnings forecasts are likely to be slashed as inflation and interest rates rise. That's the view from our latest Markets Live Pulse survey. We'll get to details about that. We'll also speak to this man, Valdis Dombrovskis, European Commission President. We will talk to him about global trade, also about reconstruction in Ukraine. Very topical today. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, And for years now, we are dying slowly but surely, and our lifespan is reducing every day.
This is Bloomberg Markets. Welcome back to the programme. I'm Anna Edwards here in London. Coming up to the midway through the morning here in London, European equities making modest gains this morning, or up by 0.8% actually on the Stoxx 600. Let's get to this week's Markets Live Pulse survey, which says, don't let optimism among equity analysts fool you. The stock market is likely to face an earnings shock as the economy falters. Joining us now is Ven Ram, our Markets Live editor. Ven, very nice to have you with us. So an earnings shock is something I talked to a number of guests about. Do you see that coming down the track? Is that going to be the story of the second half of this year?
Morning, Anna. I definitely think that earnings growth as on the S&P will definitely come down. Is going to about trend growth in the economy. I don't think that's going to persist indefinitely. So I think a decline in earnings is definitely on the cards. But I would be careful in defining an earnings shock. Not too sure at this point whether there's going to be such a big shock as there's going to be a decline, but a shock, I'm not too sure. Next year, 2023, in the second half, I think there's going to be that's going to be the period when we are going to get any kind of earnings shock, because you see the yield curve hasn't inverted yet, and it's very unlikely that we get a recession before a contraction in the before an inversion in the yield curve. That's never happened in history, and I don't see it happening now.
Okay, let's home in on one of the markets I know that you've been looking at in detail, Ven, and that is the FTSE 100. Earnings yield looking good relative to others, more than 10%. Dividend yield, you say 4.4%. Return on equity, 12%. But I suppose to have faith in any of those numbers, you have to believe that the margin estimates are up to date, that dividend estimates are up to date. Should we have confidence in those kind of forecasts for this year?
That's a great question. I do think that even if you give it a margin of safety and to mark down those dividend yield forecasts by, say, 10 to 15%, I still think that's a pretty decent pickup over what is expected on the S&P, which again is likely to be revised lower. So I do think that, I do think that the FTSE 100 dividend yield is pretty compelling at this point. And I'm not saying that the FTSE is going to rally, but we have seen how the FTSE has held up better than the S&P this year. And I think that may continue to be the story because of these factors that I've mentioned: the earnings yield, the return on equity, and the dividend yield.
It seemed earlier on this year we were all obsessed with inflation. We all still are in a lot of senses, but bond markets seem to have turned things around and are having a different conversation at the moment, concerned maybe more about global growth. We've seen this in various geographies, but you've pointed out what's going on in German bonds. That nation's two-year bond yield slumping almost 60 basis points in the past 2 weeks. Do you think that move lower in yields that we've seen, is it sustainable then, or is this just a short-term focus on growth, and then we get back later in the year to thinking about inflation once more?
I very much tend to think that's a tactical rally, what we have seen in front-end German bonds, simply because if you look at the market pricing on the OIS pricing on the ECB, the markets are expecting something like 140 basis points of tightening this year alone. And that is a pretty phenomenal increase in the benchmark rate. And if the OIS markets are reading the tea leaves right, then there is no way those front-end bond yields in Germany are sustainable. At the moment, we are around 58 basis points. And if we are going to get 140 basis points of tightening, more likely 150, say, front-end German bonds, what we have seen so far is a tactical rally, not a secular rally.
Okay, and what about what we see in treasury markets? Would the same apply? Because the direction of travel maybe has been similar there, even if the magnitude of the move has not been.
Absolutely. I think that the markets, as we just discussed, the markets have been fretting the possibility of a recession or a sharp pullback in earnings growth and the economy. And I do think those concerns, while valid, I do think that they are a bit overdone at this point. Therefore, I do expect treasury yields to climb back a bit higher from here.
And where does that leave the euro? We've got the euro at 104.37, Ven. What's in the driving seat there? Is this about relative yields? Is this about the ECB needs to catch up with the Fed and the tightening cycle? Or is it going to be about the growth story in Europe and gas prices? What's going to be in the driving seat for the euro?
The gas prices definitely represent a shock to the economy. There's no question about it. But ironically, they also push up inflation expectations. And the ECB, from what President Christine Lagarde has been telling us, is that they're focused on inflation, on quelling those inflationary embers. And that will mean that they will keep raising rates. They will start raising rates in July and they will keep going. And if they do that, the euro is bound to be supported because of real yield differentials will tend to move in favor of the euro, notwithstanding what is happening in Germany. I do think that the euro will be supported, definitely.
Okay, Ven, thank you very much. Thanks for your time. Apologies, everybody, for slight interference in the picture there with Ven Ram from our Markets Live team, but important conversation on the markets to be had. Right, 10:20 here in Europe, 11:20 if you're in Paris or Berlin. Coming up on this program, as the war in Ukraine continues, the government and policymakers are also looking to the future. We will speak to Valdis Dombrovskis, European Commission EVP. That conversation around reconstruction in Ukraine, that's coming up. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to this special edition of Bloomberg Markets. Let's keep you up to date with news from around the world. Here's Leanne Gerrans with the first word.
Russian troops are coming closer to their goal of taking over Ukraine's Donbas region. Ukrainian forces withdrew from a key city in Luhansk province, saying that extending its defense would have led to fatal consequences. Meanwhile, Ukraine will unveil a blueprint this week for rebuilding the country. It's expected to cost hundreds of billions of dollars. Now, more UK firms than ever before are expecting to raise prices in the next 3 months. That's according to a survey from the British Chambers of Commerce. The findings suggest the highest inflation rate in 4 decades is likely to climb further as firms pass on higher energy, fuel, and also wage bills. China is moving to quash a new coronavirus outbreak that could spill over into one of its most economically significant regions. The raises that spectre of disruptions in supply chains for solar panels, medicines, and semiconductor chips. Authorities have locked down several countries in attempts to keep the virus from spreading in the Yangtze River Delta region. And a Senate Democrat called on President Biden to repeal tariffs put in place by the Trump administration. In a newspaper opinion piece, Senator Tim Kaine of Virginia says the tariffs have significantly changed China's trade practices and are contributing to higher prices for Americans. Kaine called the duties direct taxes on American families and imports. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Leanne, thanks very much for that. Leanne Gerrans with an update on your first word news. Let's check out the markets briefly for you. European equities moving higher this morning. It is the 4th of July. We're without the US, but stocks here in Europe moving up by 0.8%. Coming up, more on the markets. We'll speak to Flowbank CIO Esti Dweck. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back. This is Bloomberg Markets. I'm Anna Edwards, live in London. This is a special edition of Bloomberg Markets, of course, because it is July 4th, so no trading in the United States. Lots of other markets, though, around the world are open, and here in Europe, we are in full force. So European stocks are on the rise, up by 0.8%, to some extent playing a bit of catch-up from Friday's close, where the European picture looked a little gloomier than the end-of-the-day picture in the United States, so we played catch-up with that. US futures, for what it's worth, even though no cash trading today, they are pointing a little bit lower, though, so we'll see how long we hang on to these gains here for European stocks. But that's the mood right now. We're selling out of European debt, and we saw the yields have been going higher, and I just showed you what's been going on with the Italian story right there. Interesting to keep an eye on what's going on with the bond market narrative as we pivot between inflation and growth concerns. Let's get further soundings on the global economy. Mohamed El-Erian has been saying that the Fed could blink if inflation doesn't slow. Take a listen to what he had to say.
The message was crystal clear from this week's remarks by central bankers. They worried about inflation getting entrenched, rightly so. So I think the notion that the Fed will blink early this time based on credit issues is not likely to happen. I do think, and you and I have discussed this, that we face the risk of a flip-flopping Fed in a few months when they realize that the economy has slowed, but inflation is still not under control.
Okay, really interesting, nuanced view there from Mohamed El-Erian. So he doesn't think that the Fed will blink when it comes to credit issues, but there is some room for some flip-flopping of Fed policy. This as EU policymakers remain divided over the path of tightening at the ECB. Flowbank's CIO, Esti Dweck, now joins us with her analysis of what to expect from these various central bank stories around the world. Esti, let's start with the Fed then. So Mohamed El-Erian there talking about how he doesn't think that credit is going to be the thing that will make the Fed blink, in his words, but he does see some room for flip-flopping, and a number of people we talk about, yes, we're going to see this focus on inflation in the short term, medium term even, but then we are seeing the market starting to price in cuts over the medium term. When do you think that the Fed pivots from this inflation focus to being more concerned about growth?
Well, I think it depends a little bit on your definition of blink, right? If you think that the Fed is going to pause or going to reverse at some point this year, that is unlikely. But I do think that at some point we're starting to get different signals that are disinflationary. I don't know how quickly inflation comes down, but there are a number of signals, whether it's supply chain normalization, used car prices in the US, commodity prices retreating somewhat as well. We're starting to see that inflation should be coming down over the next few months. And hopefully, by the time we get to Jackson Hole, with a couple of these disappointing growth prints or economic data prints of recent days showing that growth is coming down, by Jackson Hole, the Fed should be able to at least acknowledge that growth is cooling. And that means that it does, again, they might not pause and certainly won't reverse, but they don't have to be in aggressive tightening mode the way they have been in the last 3 months.
Esty, is there a level of inflation that you think then would allow, I mean, you described a situation where which allows the Fed to pivot a bit. I spoke to a guest earlier on, though, who was saying actually it's to do with an inflation level, and maybe that level would be 3%, and that would allow the Fed to pivot in its thinking. But then opinion varies as to how quickly we would get back to a level like 3% on inflation. What do you think the Fed is weighing up when it thinks about that?
Well, I think the Fed knows it's going to take probably a year and a half to get back down to 2%. Even if growth slows, inflation will take some time to come back down. I don't think we're seeing 3% in the next couple of months. I'm not even sure we can get to 3% by the end of the year. Can we get closer to 4%? on some inflation numbers for sure, or on the headline CPI, 4.5, that would already be a move down, and that means your core is, again, maybe closer to that 3%. It is going to take a little bit of time. I don't think the Fed has an actual figure in mind. I think they want to see that this is a trend. They want to see that month after month, inflation is coming down, and we don't have that blip like we had with the May CPI that caused so much panic. I think that's more really what they're focused on. But in the month of June, a number of the data is showing that the economy is cooling, and that might be happening a bit sooner than they were anticipating as well.
So where does that leave you in terms of investment strategy then, Esti? So we're still focused on inflation. Inflation is set to come down. You see some signs, some signals of disinflation still to come, but still at these elevated inflation levels. So where does that leave you in terms of strategy and investment priorities?
Well, still more on the cautious and defensive side. I think the next couple of months are going to be pretty painful. We haven't seen all the earnings revisions we're going to see, even though the market knows they're coming. I think as they come through, as we get maybe a couple of warnings from some retailers over the summer in terms of earnings reports as well, that will probably cause a little pain and some bumpy times for markets again. So higher cash levels, still slightly more defensive positioning. A little less concerned maybe about the sovereign side, because we could get another spike at some point, but it does feel like we've probably seen a big part of the move already. And of course, there is a bit of that. If those growth fears come back, there's a little risk on spreads widening further, even though investment grade is holding in better. So investment grade over high yield. But some of it is also deciding not to change too much. It's been a very difficult first half for everyone. One of the, the toughest in the last 50 years. Some waiting, and as long as your sort of base case scenario continues, I think that's also a decision that's not always easy to make.
We're just seeing a headline across the Bloomberg that says that President Biden may announce a decision to cut Chinese tariffs this week. This according to other news organizations, Esti, at this point. But we'll obviously be looking for confirmation. If that is something that were to come to pass, is that the kind of thing that could make a material difference, or is this all politicking at the margin?
It feels like it would be more at the margin at this point, because we know that the tariffs are probably adding a little bit to inflation, but it wouldn't suddenly bring inflation down a couple of percentage points over the next couple of months. It would certainly be a very positive signal for the market, again, in the middle of a lot of not as positive signals. So certainly a step in the right direction, but not a game changer at this point.
Okay, not a game changer, but a step in the right direction. Thinking about here in Europe then, Esti, in a bit more detail, we'll hear from Christine Lagarde at the end of this week, then we'll hear from the ECB later on this month. Clearly, there's an unknown around the exact details of this anti-fragmentation tool that the ECB is working on, but post-Draghi, post the OMT, there's a lot of expectation here, isn't there, that they can continue to bring out these projects that will satisfy market demand. What should we look for?
Well, that's the big question. They wanted to shut the QE and close out the emergency program before hiking rates. So that's done so that they can hike rates in a couple of weeks. The question is, what kind of anti-fragmentation tool can you have that doesn't have QE in it or outright bond purchases? So that's one of the big questions. And if there isn't any QE, and then it's more of a sort of ESM loan mechanism, we've seen that some of the southern countries don't really like the conditions that are attached to that. So would there be enough demand? So the rhetoric has worked quite well. There is confidence that the ECB can do something. The practical details are probably going to be a little more complicated. And as we've seen sometimes with the ECB in the last couple of years, we might not get all the details that we're hoping for by July, especially if spreads have held in a little bit in the meantime. So I think more question marks, but at some point, if they really want to rein in those spreads, we probably have to have some form of purchases.
Okay, Esti, thanks so much. Thank you very much for your time. Esti Dweck, Flowbank's CIO. Now, keeping up to date with news from around the world, here's Leanne Gerrans with your First Word update. Leanne.
Anna, good morning. In Turkey, the inflation rate in June hit 79%. That was slightly less than expected. Global shocks in food and energy markets added to pressures from currency depreciation and low interest rates. Inflation in Turkey has been in the double digits almost continuously since 2017. Now, the European Central Bank is reportedly exploring ways to keep banks from making windfall profits from its subsidized lending program. That's according to the Financial Times. The ECB provided more than $2 trillion in loans to Europe banks during the pandemic. With interest rates set to rise, the FT said banks could earn up to $25 billion in extra profits. Now, European governments are alarmed by a Russian disinformation campaign happening in Africa. Russian diplomats are pushing the narrative that sanctions and not Russian blockades are causing shortages of grains and fertilizer in Africa. A senior European intelligence officer said the Kremlin had manufactured the debate as a means to get all those sanctions lifted. And more changes at Credit Suisse. Bloomberg has learned it's cutting more than 24 frontline jobs at the investment bank over in Asia. The reductions fall across business, including deal making and trading. Credit Suisse has warned of a third straight quarterly loss tied to volatile markets and clients cutting back on risk. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Leanne, thanks very much. Leanne Gerrans with the First Word News Update. Coming up on this programme, more UK firms plan imminent price increases. We'll get more on the British Chambers of Commerce quarterly economic survey with its Director of Policy and Public Affairs. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is Bloomberg Markets. I'm Anna Edwards here in London. Welcome back to the programme. European stocks making gains this morning, up by 0.9% on the Stoxx 600. Let's focus in on what's going on in the UK. More UK firms than ever before are expecting to increase prices in the next 3 months. That's according to the British Chambers of Commerce and their quarterly survey. Joining us now for more is Alex Veitch, who's the BCC Director of Policy and Public Affairs. Alex, very nice to have you with us. So give us the top line, if you like. Summarise the big takeaway from this particular quarterly survey.
Well, I'd like to highlight two things. The first is that 2/3 of firms that we survey are intended to put up prices, and about 3/4 of firms are not likely to invest, at least increase investment. And so those are troubling findings. I would say not a huge surprise given the inflationary pressure on businesses at the moment, but they are watch outs for the economy and things that we'd like to talk to government about helping to remedy.
What would be the thing that would encourage businesses to invest more? Because if you look back at the path of investment in the UK versus other countries since around the middle of the last decade, things have been weaker in the UK than elsewhere. And with labour costs on the rise, you might think that would incentivise some businesses to invest, especially with an expectation that money gets more expensive and interest rates are also rising. So what is needed to encourage businesses to invest, Alex?
Well, it's a really good point about investment and arguably productivity in the UK needing a jump start. Right now, the government's got a good chance to make a real difference here because it is reviewing the way that it uses the tax system here in the UK to incentivise investments through various capital allowances, which means that you can offset investment, whether it's in plant and machinery or in some cases renewals or upgrades to buildings and premises. You can offset that against profits. So we're calling on government to set a stable, long-term, clear and importantly, a business-friendly approach to these investments so that we get a long-term view and businesses can plan to invest and claim back tax against that investment.
The other trend that you point towards then, Alex, as well as that investment trend, is also around companies increasing prices. You said 2/3 then set to increase prices. Obviously, we know what the drivers are. They themselves are experiencing higher costs. What's this all going to mean for company margins, do you think? Are businesses going to be able to pass on costs sufficiently that they protect those margins, or is that not going to be achievable?
Well, it's hard to generalise between different sectors and different types of business, but certainly what we hear through our Chamber Commerce network, which predominantly represents smaller businesses, is that margins are wafer thin, are highly stretched, and this is what's unfortunately causing the survey results that we see. And so unfortunately, because passing prices through and raising costs for consumers is not what anybody wants to do. And so it's a delicate balancing act businesses have at all times about margin and cost. But certainly these kind of inflationary pressures are not those that can be absorbed by businesses. And that's why you are seeing prices go up. You are seeing ever increasing inflation in the UK and probably will stay that way for some time.
Yeah, and then subsequent to that, we may see, of course, Labour asking for more money in a tight labour market, Alex. So what does this mean for the Bank of England? What clues does your report hold for them? I suppose this line about prices being on the rise is going to fit with their own findings and expectations.
That's right. You know, it's a contribution to where the Bank of England go. I mean, clearly they set monetary policy as an independent bank, and that's absolutely vitally important. I think what we'd like to land with the bank is that there are, I suppose, structural inflationary pressures around our job market here in the UK and about supply chain costs. You know, COVID essentially shut down the global supply chains for 2 years at a staggered rate across the world, and it's still rebooting. It's still taking time to come through, and we've all seen delays and cost pressures in supply chains. And here in the UK, and actually I think across the EU as well, there is a shortage of people to do the kind of jobs that have been plentiful in the past. So staff costs are increasing as well. And also, interestingly, we're seeing reports from GfK and Lloyds that consumer confidence is falling, and that is a worrying trend. So I think if the bank's looking at interventions to try to manage demand or at least incentivise decreased demand, That's where we think they should take a second look, because consumer spending is about 2/3 of our economy, GDP, and it is important at this difficult time that we encourage people to not hold back too much on their expenditure, and so that we can keep businesses going and ride out this rocky period.
Okay, thanks so much, Alex. Really good to speak to you. Thanks for joining us, Alex Veitch, the BCC Director of Policy and Public Affairs. Coming up on the program, Larry Summers, former US Treasury Secretary, said that the risk of a recession might be coming sooner than he anticipated. We have more on his view next. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Markets. I'm Anna Edwards, live in London. Former US Treasury Secretary Larry Summers says there's an increasing risk the looming recession he's anticipated will start even sooner in 2022, and that inflation might cool as a result. Summers spoke in an interview with Bloomberg's David Weston.
Look, I think we're seeing that inflation, which has eroded people's purchasing power, the end of the fiscal stimulus that gave people a lot of cash last year, higher interest rates that are discouraging housing and housing-allied kinds of spending, generalized increases in uncertainty and just a bit more feeling of insecurity, all of that is taking a toll on spending. My guess is that that's going to continue for some time, and I think you'd have to say that whatever you thought about recession risks a month ago, the recession risks through the year 2022 have to have gone up in a quite material way. I felt for a long time, as you know, David, that we're not going to have inflation return near target without a significant economic downturn. But that downturn could happen either because interest rates set by the Fed rise very, very sharply, or it could happen because of a kind of self-fulfilling process coming out of the high inflation and reductions in people's incomes. And the latter possibility is looking more likely today than it was. And of course, if the economy did go into recession in the next 6 to 9 months, then you'd probably see a reduction in inflationary pressures, and you'd see the Fed probably feel that it had to push rates up less than it would if the economy was continuing to grow strongly and labor was, and there was very, very strong demand pushing up wages and prices.
So Larry, I just want to be very precise here, because you and I have talked quite a bit about the likelihood of recession this year and next. And you've said next year you think it's much more likely than that. But thus far, you've said this year maybe not so much. Are you saying, given the data coming in, perhaps a recession or a significant downturn, whether it's a technical recession or not, maybe coming faster than you thought?
Yeah, I think the risks of a 2022 recession are significantly higher than I would have judged 6 or 9 weeks ago. Look, David, we've got the first quarter numbers in the bank. They are negative for GDP. There are many forecasters who believe that the second quarter, which ended yesterday, also had negative GDP growth. It's not really the formal definition of recession, but people often say it's a recession when you have 2 quarters of negative GDP growth in a row. And there's, I think it's probably close to a 50-50 chance, maybe it's a bit less than that, that we've had 2 negative quarters in a row. So I think you have to say that the chance that a recession is ultimately dated as having begun during 2022 has gone up significantly.
That was Larry Summers, former US Treasury Secretary. Let's quickly check the markets as we get to the top of the hour. European stocks without the United States today, of course, but European stocks up by more than 1% today. The stock 600, that is, the FTSE 100 up by 1.2%. Perhaps it is the fact that yields are retreating, so the bond markets are retreating, yields are going higher that we need to focus in on. We have yields higher across a number of geographies here in Europe. Here's the US dollar for you, actually retreating a touch this morning, and Brent crude is down by 0.2%. Coming up, more on the markets. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning and welcome to Bloomberg Markets. I'm Anna Edwards, live in London. Coming up on the program, mounting recession fears casting a shadow over markets after its worst performance in over 3 decades. German unions warn the country's gas crisis could wipe out entire industries. And investors looking ahead to a big week of economic data, including the US payrolls report. Let's check on the markets then for you. Yep, Christine Lagarde, she'll also be speaking. Lagarde's next move will be in focus later on this week. This is what we have for you on European markets right now. This is a bond market snapshot for you. Stocks are moving higher, and we're getting out of, it seems, European debt at this point. So German 10-year, French 10-year, UK 10-year, and Italian 10-year, all showing you the same pattern, if you like. So in contrast with what we've seen over the last couple of weeks, we are seeing here that the German debt is extending its slide. Yields are rising, and it's in Germany, in France, in the UK, and everywhere else, it would appear, across Europe. So we don't have cash trading on treasuries markets, but we have plenty to talk about when it comes to European bond markets this morning. Now, keeping you up to date with news from around the world, here's Leanne Gerrans with the first word. Leanne.
Hi, Anna. Russian troops are coming closer to their goal of taking over Ukraine's Donbass region. Ukrainian forces withdrew from a key city in the Luhansk province, saying that extending its defense would have led to fatal consequences. Meanwhile, Ukraine will unveil a blueprint this week for rebuilding the country. It is expected to cost hundreds of billions of dollars. Now, in the US, President Joe Biden may lift some of the Trump-era tariffs on Chinese goods soon, according to reports. According to the Wall Street Journal, the president could announce his decision this week. Treasury Secretary Janet Yellen has called the tariffs a drag on the economy, but others in the administration see tariffs as leverage to get concessions from China. More UK firms than ever before are expecting to increase prices in the next 3 months. That is according to a survey from the British Chambers of Commerce. The findings suggest the highest inflation rate in 4 decades is likely to climb further as firms pass on higher energy, fuel and wage bills. And more changes at Credit Suisse. Bloomberg has learnt it is cutting more than 24 frontline jobs at the investment bank over in Asia. The reductions fall across business, including deal making and trading. Credit Suisse has been warned of a 3rd straight quarterly loss tied to volatile markets and clients cutting back on risk. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Thanks very much, Leanne. Now, downgrades from the biggest banks on Wall Street continuing to roll in as economists sour on their growth outlook.
We're looking at an economy losing momentum faster than what we anticipated.
Economists have begun to cut their top-down economic forecasts for GDP.
This is a global story.
Input costs have risen substantially.
We're seeing demand destruction in some areas.
The consumer is on somewhat more fragile footing.
We do expect the Fed to hike rates more aggressively.
The Fed has been driving the car looking through the rearview mirror.
The economy is slowing, and the Fed is saying that's collateral damage.
Companies
and consumers need to get ready.
Frankly, we think they can keep going.
I don't think they blinked. We did see some pretty notable downward revisions.
We expect more downgrades.
We're joined now by Joost Beaumont, ABN AMRO Senior Fixed Income Strategist. Thank you, Joost, for joining us. We need to get to a conversation about the European growth story, but if I could just linger on some of the interesting comments made there by some of those guests talking about the US. One of them saying, you know, the US economy is slowing, but that's just going to be collateral damage for the Fed. Do we have a sense of how much the Fed will allow the US economy to slow and the labor market to deteriorate?
Well, I think if you talk about the US, I've little to add to what the other analysts have said. We are also quite negative on the growth outlook, and indeed it seems that the economic downturn is coming quicker than anticipated if you look at recent data. But on the other hand, inflation is still pretty high. The labor market is pretty tight, so the Fed is clearly on a mission to fight inflation. And the weakening in the growth outlook is in our view at ABN AMRO no reason for the Fed to change course. So we still expect quite aggressive rate hikes in the US in the coming months.
Yeah, and do you get a sense that any peak in inflation, Joost, would change that assessment from the Fed, or that just allows them to carry on tackling inflation, which will still be at elevated levels even if it's come through its peak?
Yeah, true. But I don't know whether there's a peak level of inflation that they're looking at. I think they mainly look at the inflation expectations because it's key for them to prevent inflation expectations becoming de-anchored. And I guess that's their biggest worry. So if inflation expectations come down to say levels maybe around 2% or whatsoever, and we see a bit of weakening in the labor market, then I guess the Fed will be more confident that indeed inflation is under control. But clearly it's not there yet. So for now they are on a quite determined path.
Is a technical recession in the US, quote unquote, all we have to worry about, do you think, Joost, or do things become more material than that?
Yeah, well, economists and financial markets are always a bit hyped up about technical recession, 2 quarters of negative growth. Well, in the US, we might see this already happening in Q2. It's not our base case, but it is possible given quite low consumption growth. But I think it's more what you should look at is the longer term, the longer path, and then clearly there are a lot of negatives, which is not only for the US but also for the Eurozone, where you will see household consumption, household disposable income being wiped away by high energy prices, higher inflation more generally, but especially energy bills will go up strongly. We see monetary tightening. Also, the ECB will start hiking rates, so that will lead to less favorable financial conditions, which will hit investment growth. And still we have the supply shocks. They will ease, but they're still there. And of course, the war raging on in Ukraine. So there are quite a lot of negative headwinds ahead of us, which are unlikely to go away soon. So that will lead to a slowdown in global growth, basically.
Yes, and sticking with the global themes, and I will come to the European side of this specifically in a moment, but sticking with the global themes, I mean, do you think that a US 10-year yield of, where are we, 2.88% right now? I mean, we don't get cash trading today on treasuries, we have futures, but do you think that where is the direction of travel for that, Joost, do you think, in the short term or the medium term? Because yields have been coming down despite the fact we're in a Fed tightening cycle, and some suggest this is a temporary blip down, and actually those yields will rise again as we continue to focus on inflation. What's your broad outlook for yields?
The broad outlook, if I be very short, we see rates to go up in the near term, but clearly to come down in the medium term, as we do expect the Fed actually already to start cutting rates in the second half of next year, given the weak economic outlook, and that will also lead to of course lower interest rates.
And are we're going to get to the non-farm payrolls number later on. From a fixed income strategy perspective, is this going to be a number that holds a lot of value for the markets, do you think? Or because the focus is very much on inflation, that's where it remains?
Yeah, I guess the focus will be definitely on the wage growth. If we see a strong wage growth still, then of course the risk of the wage price spiral becomes stronger, and that's something the Fed will look at quite closely, because that's what they need to prevent from happening. So it will definitely have an impact on markets. And like I said, if there's strong wage growth, maybe stronger than expected, then markets could price in a more aggressive Fed, which then will lead to higher rates. But like I said, there will be the near term, the coming month. And then later in the year, I think towards the end of the year, markets will start focusing on next year, and that should result also in a drop in rates.
What about the global growth story as influenced by China, Joost? I mean, how is that factoring into your thinking right now? We obviously have seen China taking COVID the COVID fight in a different direction from other places. The COVID zero policy very present at this point. Even then, when we see reopening impulses, that's then limited by further clampdown. What are you expecting to see from China?
Now, from China, our growth outlook is, I think, for 4 to 5% growth this year. So that's less than, for instance, also the Chinese authorities say. But of course, the lockdown measures were clearly not positive for Chinese growth, and the fact that they are now reopening the economy, loosening at least the COVID measures, will definitely mean that there will be some pent-up demand there. So that could be positive for the global growth story. Also for supply, the supply side, of course, if ships are not leaving Chinese harbors, then we feel the pain of that. And so that could be a bit of a softening, a cushion in the coming months.
Okay, we'll turn in the next part of our conversation. Yeah. Oh, less of a drag. Okay, we'll turn in our next conversation, Joost, to talking more about Europe. But just to set that up, is your base case becoming that we get a recession in Europe, or that we narrowly skirt one, or is it too difficult to say?
It's always difficult. No, it's difficult to say, and then clearly in current times, forecasting is extremely hard. But for us, we do not have a recession in the Eurozone in our base case at the moment. But we do think a downturn, like I said, is on the cards, and we will see more stagnation in especially next year. And what could drive a deep recession are energy supply cuts in Europe if the Russian really stop providing any energy.
And how likely would you, based on the research you've been doing, and I know that you've done a lot on this, the European economy's ability to cope with a Russian gas cutoff, how likely, what percentage chance are you attaching to that kind of occurrence, Joost?
They are difficult to say, but the chances are getting higher and higher, actually. Already we see quite a sharp cut in gas supply from Russia to Europe, and especially Germany and Italy are very vulnerable, as they rely a lot on gas supply from Russia. And we do think it is likely that Russia will cut supply further. And for now, policies to reduce the use or to find alternative sources of supply are still working. But if supply is cut off further, then you can think of really rationing or shutdowns in industrial sector, which will then hit the economy pretty hard.
Okay, we'll get more details on that shortly then. Not the base case.
Yeah, it's not the base case, but we get closer to it. So
Okay, Joost, thank you. We'll come back to you shortly. Joost Beaumont joining us there, ABN AMRO Senior Fixed Income Strategist. He's sticking with us on this program. Quick check of the markets. European stocks, they're up by 0.9% right now. It's quite a lot going on in bond markets. These are yields on the rise for you, so selling out of various government debt, and yields are rising across Europe. Big focus on falling commodity prices as well as iron ore prices move lower. We will get the latest on rebuilding Ukraine next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
This is Bloomberg Markets. I'm Anna Edwards, live in London. Now, while the war in Ukraine continues, the Ukrainian government and global policymakers are also looking to the future, trying to mobilize countries and multilateral institutions to look ahead to the reconstruction that will one day be possible and necessary. For more, let's bring in Bloomberg's Maria Tadeo, who is at the Ukraine Recovery Conference taking place in Lugano in Switzerland. Good morning to you, Maria. I mean, it seems quite incredible to think about reinvestment in recovery in Ukraine when we know that so much destruction is currently still happening.
Yeah, Anna, and the war we've seen has really intensified in the east of the country, with Russia, by the way, making sustained gains now for 2 weeks in the east of the country. But today, a lot of those, the conversation, as you say, it's about the fundraiser. It's about the reconstruction effort going into the country. This event, by the way, is put forward by the Swiss authorities, which, as you know, this country historically, it is militarily neutral. It has been in every major conflict over the past century. But they say politically in this, they want to be aligned with the rest of the European Union and have done so for the sanctions on the Russian Federation. Now, the numbers here, Anna, that get floated are enormous. Just 100 billion euros alone. That's for the short-term reconstruction. When you look at the whole effort, it can range from anything to 500 billion euros to 1 trillion euros. That was a number that was floated yesterday. But the elephant in this room, and you alluded to that, is the idea that right now you talk about a hypothetical. We don't know when this war is going to come to an end, the type of peace that will be achieved, if anything, between Russia and Ukraine. But also what seems to be the bigger issue, Anna, it's not the future, it's the short-term funding needs for this country, which is burning through cash every month as a result of the war effort. They say they want to continue and sustain. And that was a message, by the way, from President Zelensky, who said, even if we retreat from some positions, we'll be back. Ukraine is not going to give up on anything.
Okay, so that's the short-term needs of the country, also some of the longer-term commitments that have been made. How much does the generosity on display there, Maria, depend on the ability of the countries that are showing up at the Ukraine Recovery Conference to generate growth and to have a positive economic story of their own that they can then use to raise money on behalf of Ukraine?
Yeah, and Anna, the Ukrainians say they don't just want to focus on the reconstruction. For them, this is about building a more modern economy. We know the perennial criticism that this is still a country that has a lot of corruption issues, where oligarchs still have a lot of power. But the elephant in the room, and I think you summed it up very well, is this idea that Ukraine right now does depend from the European Union, from the United States. And the question is, for how long? And we did put that question to a number of officials at the G7, but also at NATO, and they continue to say publicly they will do it for the long run. They will do whatever it takes to help Ukraine. But the question is, what happens when the economic fallout intensifies? And we know that is going to be the real debate in the winter. There was that note last week from Deutsche Bank Research that said we're now very concerned about the energy picture for the European economy. They now price in potentially a rupture in the supply of gas going from the Russian Federation into Germany and Italy. That would be incredibly dangerous for their industries and their economies. A concern about a recession in Europe, but also the public opinion potentially shifting as a result of the inflation debate. So this is something that publicly they don't want to talk about. The line here officially continues to be, we want to support Ukraine, whatever it takes. But it is the uncomfortable debate, the elephant in the room that goes on behind the scenes.
Okay, let's talk about that with our guest there. Maria, thank you very much. Bloomberg's Maria Tadeo at the Ukraine Recovery Conference in Lugano. Let's get back to Joost Beaumont, ABN AMRO Senior Fixed Income Strategist, who's still with us. And we talked a little bit about the strains on the European economy as a result of the hard line being taken on Russia then, Joost. And let's linger on that a little more. You've put out some research describing how a gas cutoff, and we don't know if we'll see that, but that's what people are fearing might happen later on in July. If we did see a gas cutoff, how that might cascade through the economy. Give us a sense of how that moves through the Eurozone economy.
Yeah, of course. Well, if gas supply will be cut off further, that will, of course, work through two key ways through the economy. That's, first of all, you will get a price shock because energy will become more expensive. So that will definitely squeeze margins of companies, lead to further rises in energy bills of households. So overall, that will reduce household disposable income. Of course, it will result in companies maybe going bust, not being able to price on the higher input cost. So on that side, it will have a damaging impact. And then from the supply side, it will also lead to big cuts in say production if companies get shut off from say gas supply. If you get really large scale industrial sector shutdowns, that will of course lead to lower production. Then that filters also through to suppliers to these factories. They will of course be hit, see the slowdown in demand. So it's from a price shock and a supply shock, and that will definitely bring the Eurozone economy into a recession.
That would create recession then, yeah, you think. If we do see rationing then of gas across the Eurozone, where will that fall? Will it be mostly on corporates and industry? Will it be mostly on individuals? Or will it depend on the part of the Eurozone economy and the way that the domestic gas market functions?
Yeah, I think not particularly vulnerable. If you look at purely countries, like I said, and I think your colleague also said it, it's Italy and Germany who are really rely heavily on European Russian gas. So these economies will be particularly hard hit, and of course the German economy is the biggest in the Eurozone. Italy is also one of the 6 largest, so that will definitely have a huge impact. And then if you look breakdown by sector, of course, companies operating in the energy sector will likely be hit, but also the ones that use energy at a large scale. If companies go bust, so it starts maybe in the corporate sector, but it can also filter through to the financial sector, with banks maybe seeing an increase in non-performing loans or having to increase their loan loss provision. So banks can be hit as well. And maybe if you take it to the max, then if governments want to ease part of the burden, they maybe need to step in, and that will also cost money, of course. So in the end, you
we're
can
already
even see
seeing
rise
that
in
being
government debt.
talked about. Yeah, in Germany, we're seeing that being talked about, aren't we, with the bailout of Uniper being discussed. Yes. Would you expect broadly a bigger role for European governments here for the fiscal side?
It could be, although it's very difficult for governments to continue to ease burdens that stem from, say, supply shocks. Of course, they already did a lot during the COVID crisis, so government debt has increased already, and there are of course limits to that. So the capacity to do something becomes less and less. Of course, the German government finances are in pretty good shape, so there's more room there. So I guess it's more that they want more within the EU. You also can help each other. So, and I think there was last week von der Leyen already speaking about maybe just the EU approach for this.
Yeah, absolutely. We'll focus on that then. We'll listen to what she has today. Joost Bomel, thank you very much. Apologies for interrupting. ABN AMRO Senior Fixed Income Strategist, just coming up towards a break. Coming up, we'll continue this focus on global inflation. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
This is Bloomberg Markets. I'm Anna Edwards here in London. This special edition of Bloomberg Markets, because it is July 4th. If you are celebrating in the US or elsewhere, then happy Independence Day. This is a picture across the European bond market space right now. We're seeing a bit of a reversal in some of the trends we've seen over the last couple of weeks. This is bonds being sold off and yields actually rising once again, up by 9.9 basis points in France, up by 8 or so in Germany, 14 basis point higher over in Italy and Spain, also showing some moves higher in those yields. And this in keeping, I suppose, with what we're seeing on broader assets. So equity markets being bought today, so up by around 1% on the Stock 600, the FTSE 100 up by just over 1%, the CAC 40 also up by just over 1%. Let's keep you up to date with news from around the world. Here's Leanne Gerrans with your first word.
Hi, Anna. Experts are calling it the biggest cybersecurity breach in China's history. Unknown hackers claim to have stolen data on as many as 1 billion residents in China after breaching a Shanghai police database. The personal group has offered to sell more than 23 terabytes of data for 10 Bitcoin, or about $200,000. Now in Turkey, the inflation rate in June hit 79%. That was slightly less than expected. Global shocks in food and energy markets added to pressures from currency depreciation and low interest rates. Inflation in Turkey has been in the double digits almost continuously since 2017. The European Central Bank is reportedly exploring ways to keep banks from making windfall profits from the subsidized lending program. That is according to the Financial Times. The ECB provided more than $2 trillion in loans to European banks during the pandemic. With interest rates set to rise, the FT says banks could earn up to $25 billion in extra profits. And Tesla has snapped a 2-year streak of increasing deliveries every quarter. The electric car maker delivered a smaller than expected 254,000 cars worldwide in the 3 months to June. A coronavirus-related shutdown at the Tesla factory in Shanghai has hurt production. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Leanne, thanks very much. Now, for those planning on traveling in Europe this summer, better brace yourselves. Travelers are paying even more for a plane ticket and yet have less of a chance of actually making it to their end destination. For more, let's bring in Bloomberg's Laura Wright, who's been looking at the details here. And Laura, it's as if the global world of aviation knew you were about to talk about this subject, because we just see other broadcasters in Belgium talking about Brussels Airlines cancelling 527 more flights this summer. SAS, then the Scandinavian airline, saying it sees strikes leading to cancellation of around 50% of all of their flights. This is certainly a hot topic.
strikes and capacity cuts threatening to derail the recovery of the travel sector that the industry has been yearning for since the pandemic. The common denominator for strike action, if we start there, is pay. Workers' wages eroded by inflation. They want to be fairly compensated, particularly at a time when demand in the industry is booming. To add to this, capacity cut announcements. Airports and airlines are struggling to operate as passenger numbers normalize. It's why we've seen Schiphol Airport in Amsterdam, for example, announce that their capacity will be 20% lower over the key summer period this year. For Gatwick and British Airways, the drop will be 11% and 10% respectively. Many workers left the industry during the pandemic. They found jobs elsewhere and are reluctant to return to what is now seen as a volatile sector. The worker shortage is also exacerbated by long wait times for new employees to pass security clearances, and it's why IATA forecasts that the worker shortage is around 200,000 people from where it was in 2019.
Laura, thanks very much. Bloomberg's Laura Wright. And I know that a number of those aviation companies have seen their stocks fall in anticipation, or as we watch all of these strikes play out and other issues surrounding the sector. And just as I was mentioning that SAS line earlier, that they see strikes leading to cancellation of around 50% of all their flights, their shares are currently down in session, down by around 10% as a result of that. Now, the ECB honing its plans to keep bond markets in check as it hikes rates. Let's bring in TS Lombard chief economist Freya Beamish to discuss. Freya, we were just talking about one of the threats to the global economy, an aviation sector that is both booming and also struggling to cope. But let's think more broadly about the European growth story. I talked to one guest earlier on this hour who was saying that a recession, not the base case at the moment, but if the gas taps from Russia get turned off, then it will be. Give us a sense of what your expectations are.
I think even short of the gas taps being turned off, that we can expect recession with the extent of erosion of real incomes that we're seeing across Europe. That we have to continue to make this distinction between the U.S. consumer and the Eurasian consumer, and the U.S. consumer has a much greater legacy of stimulus. Wealth creation that happened over the course of the pandemic than does Eurasia, and Eurasia is more exposed to the energy crisis, or at least Europe is more exposed to the energy crisis. So I think the mismatch essentially between demand and supply in the euro area is much less than it is in the US. The reason why at this stage in the game we still have these horrendous inflation numbers coming through is because the composition of demand has not yet normalized. So when we look at, and obviously the aviation industry is at the very eye of the storm as the composition of demand that was excessive in the pandemic in goods and in-home services is now switching to extra home services and particularly travel. But because over the course of the pandemic there's been no revenue in these sectors to which demand is now cycling back, there's been a huge degree of atrophy, both in terms of lack of capex and in terms of, as Laura was saying, that people have been sucked into jobs in other sectors and are now perhaps not quite so willing to come back. So you are going to get these upside surprises, and you are going to get these sort of mini bursts of wage price. I hesitate to say spiral, but kind of it was a second round effect. But at this stage, it seems like it's more one-off payments rather than the stickier kind of rise in wage growth that would lead to those concerns.
So Freya, you're saying that the US consumer has more of a legacy of that stimulus and was boosted by that during the pandemic more than the Eurasia consumer. Of course, European inflation, though, still at very lofty levels. Is that mostly then, leave aside aviation and some areas of services, is that very much then, do you think, in your view, being driven by supply chain constraints? And are you seeing signs of those alleviating?
I think most of the inflation that we see at this stage in Europe is either imported or as a result of these compositional effects because demand has not yet normalized. If we go into kind of next year, we're going to know what the composition of demand is going to be in the post-COVID economy. But at this stage, we've still got the kind of the revenge summer, and the composition of demand is very much shifted towards an area of the economy where there has been an atrophy of supply. So the supply-demand mismatch at this stage in the game seems a lot greater than it actually is in terms of the aggregate for where we're trending to for for Eurasia. So that the longer term trajectory for inflation and the requirement for the ECB actually to stamp out inflation by running actively tight policy is much less than it is in the US.
And sticking with European themes, the anti-fragmentation tool no doubt will get a lot of attention as we go through July. We've seen a lot of activity in bond markets. Yields had been coming down after we got mention for the first time of that anti-fragmentation tool, but just on the rise once again this morning, Freya. What are you going to be looking for as we go through this month in terms of that detail? Do you think there'll be detail forthcoming?
I'm not sure that there will be. There's not a great track record of detail on these types of things. And I guess the great hope is that we never have to answer a lot of the questions on kind of how is this going to be sterilized, what exactly is going to be bought, what exactly is the kind of the implied spread, and that markets will just sort of take it for granted that the ECB is there and there is some kind of an implied spread, but beyond which they're not willing to allow it to go, in which case, what's the point of taking these costly bets against the ECB? But again, kind of looking to other central banks as a kind of a precursor to this, the Bank of Japan has had a yield curve target for some time now, and it does get tested every now and then they do shift the goalposts. So you could get some move like that. At this stage, it's not our base case that you have enough of a test of the implied kind of spread which the ECB is willing to countenance, that the test from markets is not great enough to actually raise the questions on how this is going to be sterilized. Because if there is a requirement for a greater degree of purchasing in the periphery, then the kind of the logical way to sterilize that, if you're actually trying to avoid QE, would be to sell bonds or to sell some equivalent security, and you're mopping up at the same maturity as you're buying. Whereas in reality, what seems more likely to be happening is you would be sterilizing in quote unquote. You'd be sterilizing by shifting around the short-term assets of the banking sector and financial sector, which is much less of a true sterilization. So there is the kind of the threat that this turns into a kind of a further round of QE and feeds into the euro weakness, which essentially just feeds into further kind of cost push inflation, which is the ultimate problem that the ECB is grappling with in the first place. So that's a tail risk rather than the base case at this stage.
Yeah, I mean, and what do you expect to see on the euro then, Freya? Because some talk about, yes, of course, the interest rate differentials and the way that this all plays out with peripheral spreads. Yes, that could be a driver for the euro, but also where we started the conversation, the weak growth dynamics in Europe and the threat from gas and Russia turning off those taps. Where does the euro head in that context?
I think, again, we have to look to what's happening in the US, and I do think that we probably are going to go through a bit of a lull in terms of that Fed hawkishness, and that has been the kind of the main driver of a lot of the currency moves that we've seen so far this year. So if we get that lull in the US, which is generated by growth scare and the beginnings of a disinflation, which I do think will turn out to be a transitory disinflation nonetheless over the next kind of 6 months or so, there could be a bit of a lull in terms of where the Fed is going. And we could start to get further downward pricing of the implied peak in the Fed funds rate in March, April next year. And that releases a bit of pressure on currencies from the European perspective as well. But kind of going further into the future, the reality of the situation is that it probably does take the Fed raising rates by raising nominal yields such that real rates finally become constraining if you want to get the final reset of inflation in this cycle. And at that point, we could start to think about further euro depreciation, which is a problem for the ECB's perspective, because that is a spiral. I said not really willing to talk about wage price spirals, but there is a spiral in terms of currency depreciation and growth differentials starting to tilt further towards the US, and then further currency depreciation. in that
Freya,
sense.
thanks very much. Thank you for joining us. Freya Beamish, TS Lombard's Chief Economist, joining us on this special edition of Bloomberg Markets on the 4th of July. Quick check on a few things moving around in markets. I mentioned those lines coming through from SAS, the Scandinavian airline, warning that the company's future is at risk as the pilots' union goes on strike. Laura Wright was giving us plenty of details about other strikes that are taking place and other forced cuts to capacity because of understaffed levels, either at airports or at air traffic control or at the airlines themselves. This is the impact we see of that strike news on SAS, the share price down by just shy of 11%. Recession fears tightening its hold around global markets, bonds catching a bid as investors search for cover. That has been a story in recent weeks. We will get to a big markets conversation with Justina Lee next. This is
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Markets. I'm Anna Edwards in London. Now, weakening economic data fueling a bid into bonds with fears of a global growth slowdown weighing on markets. Bloomberg's Justina Lee joins us now. And Justina, today's market action maybe looks a little bit different. We've got some money coming out of bonds and we've got stocks catching a bid. But over the last couple of weeks, the story has been that we've been looking for places to hide from recession fears, and bond markets have benefited. Which of these trends persists?
Yeah, it's really interesting because you kind of have two factors pulling the bond market in an opposite direction right now. And we have seen a rally across bonds recently as the narrative shifted to a recession rather than inflationary fears. But today we are seeing bonds a little bit weaker. And I think the question here is, like, as much as we are worried about growth risk right now, we are also still very concerned about inflation, especially with, European gas prices still going up. And in that case, if the ECB does have to play catch up, I mean, it's kind of hard to see how European bonds can hold on to the rally that they've enjoyed in the past few weeks.
I know we also wanted to talk about whether we're seeing economic worries in stocks. And it's really interesting to think about, this is just one area of the stocks universe, but in aviation, this is supposed to be the good times for aviation, isn't it? I mean, this is of any sector, this is a sector that we really need right now, and people want to consume their product and enjoy their services. And yet we can't all, to the extent we want to, because of capacity constraints. I don't know whether that tells us anything about what we should look for in the broad stock story. What are you seeing in the stocks narrative at this juncture?
Yeah, I think, airline stocks are a great example of what we're seeing here, because on one hand, they are enjoying, the rebound in demand, but it's actually sort of the supply side that's cutting into that. And we're kind of seeing that across many industries right now, which is why analysts have been downgrading their profit estimates. And a lot of people are saying, they're expecting, even more cuts to come. And so once you kind of lose that support from strong profits, I think you can kind of see, a lot of pessimism possibly spreading across stock market.
Yeah, interesting to think about the supply side. I know that over in Sintra, that was a topic of conversation from another angle. On the monetary policy side, Augustin Carstens, for example, saying, we as economists need to think more about the supply side rather than just focusing on where the demand lies. Thinking about where demand lies, is there demand still for crypto, despite this crypto winter that we seem to have fallen into?
Yeah, I mean, the thing about crypto is that as much as people have been talking for years about how Bitcoin is supposed to be an inflation hedge, it's turned out to be mostly, just another risky asset. And so these days, I mean, whenever the S&P is down, you generally see Bitcoin and the rest of the crypto world falling as well. But it's not just that, because unlike the stock market, the crypto industry is also grappling with a domino effect, from, one of the biggest hedge funds failing, 3 Arrows Capital, now going through liquidation. We have to see what happens to their crypto assets. And today we've had another crypto lender called Vault freeze withdrawals, probably because they cannot really afford to kind of pay those high yields, pay back their customers now that perhaps their own counterparties have defaulted.
Okay, Justina, thank you very much for the update. Bloomberg's Justina Lee. Now for something different. It is July 4th. 2022 has been a big year for Boston, I'm led to believe. It is the bicentennial celebration of Boston becoming Massachusetts' first chartered city, tricentennial of the first printed map of Boston, and 40 years ago, Cheers debuted.
This year marks the 200th birthday for the city of Boston. It was back on February 23, 1822, that the Massachusetts state government moved to redesignate the rapidly growing town of Boston to the city of Boston. It was an acknowledgement of a 40,000-strong population that had tripled since the end of the Revolutionary War. The petition was ratified in March of that year and became official on May 1st.
Although the vote was 2,700 in favor, about 2,080 against. Some wanted to keep the old system.
Today, its population has swelled to almost 700,000 people, making Boston the most populous city in all of the New England region. This bicentennial isn't the only milestone being celebrated by the city in 2022. This year also marks the tricentennial of the first printed map of Boston, and we have Captain John Bonner, a navigator and shipwright by trade, to thank for that.
In the 1760s, a new map was made using Bonner's map, and essentially they just sketched in the new street.
Captain Bonner's mapping of the streets, churches, and public buildings, along with the detailed locations of waterways, docks, shipyards, and wharves, now provides one of the most comprehensive representations of what Boston looked like before the Revolutionary War. 2022 also is a big year for the city's newspaper of record, the Boston Globe. 150 years ago, on March 4th, 1872, the Globe published its first edition. Back then, a copy would set you back 4 cents, and the front page included a current events section where writers could vent about whatever was bugging them. Apple price inflation was a frequent topic back then.
There already were a lot of newspapers in Boston. There was the Boston Post, which actually was the largest paper in New England. The Globe really became initially the newspaper of the rising Irish immigrants.
Over its history of keeping Bostonians informed for 15 decades, the Globe has won 26 Pulitzer Prizes. And lastly, we raise a pint for the bar where everyone knows your name. Cheers! 40 years ago, the groundbreaking TV sitcom aired its first episode in September of 1982. The show would last 11 seasons, win 28 Emmy Awards, and make Ted Danson, Rhea Perlman, Woody Harrelson, and Kelsey Grammer household names. So as you can see, 2022 is a big year of anniversaries for Boston, and surely there will be many more to come.
So you see, it's true. It's a big year for Boston. And why are we telling you all of this? Well, here at Bloomberg, one of the ways we celebrate July 4th, of course, is with the Boston Pops, the concert, the fireworks, spectacular, all of that taking place tonight. So tune in for that if you like. Let us get back to the markets. And European equity markets are on the rise today. So we don't have US equity markets, no cash trading, of course, because it is July 4th. But the Stoxx 600 are up by just shy of 1%. The FTSE up by just over 1%, as is the CAC 40. The Xetra DAX up by 0.4%. So we are seeing stronger equity markets. The Italian 10-year yield, I put that in there. We've got yields going higher, and that seems to be the story across Europe today, in counter to the trend that we've seen over the last couple of weeks, though. We'll see which trend wins out here. Natural gas prices up by 8.6%. That's just in today's session, and this very worth watching, because we have, of course, all of this conversation about whether Russia is going to use a maintenance period on Nord Stream as an opportunity to stop sending gas from Russia to Europe. So we are certainly focused on European gas prices and what they do in response to any of those developments. That outage of Nord Stream is expected to take a couple of weeks through the middle of July. So on the other side of that, that'll be important to see whether we get that natural gas flow re-established. Iron ore also under pressure, and that goes back to our growth concerns, down by 4% right now, as we're concerned about growth in China, but also stockpiles of the stuff in China weighing on demand. So that's a look at where we are on the markets at this point. There's a lot in the mix today when it comes to the moving parts on these markets. The Asian session was broadly positive. US futures, of course, suggesting a little bit of weakness ahead. We don't have cash trading in the US today, though, as it is July 4th. But US futures are pointing down by 0.3% on E-minis. Dow futures down 0.2, and Nasdaq futures down 0.4%. No doubt that is for another day. If you are celebrating July 4th anywhere in the US or elsewhere, then have a really good day, and more programming on European and global markets coming straight ahead. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to a special edition of Bloomberg Markets on this, the 4th of July. I'm Danny Berger. It's noon in London, 7 a.m. in New York, and 7 p.m. in Hong Kong. U.S. markets closed for the July 4th holiday. Here's where we stand in Europe. At this hour, volumes very late, given that many U.S. traders are out. Hope everyone's enjoying your barbecues, whatever you're doing this holiday. If you are paying attention to markets, it is broadly risk on. European stocks almost up 1%, that being led by energy shares this morning. Now, it is certainly mixed in the energy sector itself, but that's what's leading us higher today, along with healthcare. Interesting to look at the selling going on the front end of the curve in Germany. That follows a huge rally last week, the biggest drop in U.S. 10-year yield since March 2020. For the 2-year, it was a 50 basis point slump over the past 2 weeks. Is the rally over? Given Germany's gas crisis continues to unfold, concerns of it worsening, that might just exacerbate inflationary issues. We have top of union officials over there warning that entire industries could collapse. Now, elsewhere in the commodity sector, iron ore, that also dipping. Also, a prospect of slower growth, down by 4.5%. But Goldman Sachs cutting their outlook, saying that in the near term, iron ore could slump to $90, settling around $100 in the long term. It's not just the growth issue, though. It is also the surplus of iron ore means that as growth slows down, we have a lot excess of it, and that's certainly not positive for the price. Meanwhile, Bitcoin, just in the past hour or so, flipping to gains, still struggling to get back to 20,000. We're just around that $19,000 level. So, of course, while volumes are going to be late for the holiday, an indicator that we are starting to see some improvement in risk sentiment, even though that futures are off in the U.S. so far this morning. Now let's get you a check on news from around the world. And with that is Laura Wright. Laura.
Good morning, Danny. In the U.S., President Joe Biden may lift some of the Trump-era tariffs on Chinese goods soon, according to reports. The Wall Street Journal, the president could announce his decision this week. Treasury Secretary Janet Yellen has called the tariffs a drag on the economy, but others in the administration see tariffs as leverage to get concessions from China. More UK firms than ever before are expecting to increase prices in the next 3 months. That's according to a survey from the British Chambers of Commerce. The findings suggest the highest inflation rate in 4 decades is likely to climb further as firms pass on higher energy, fuel, and wage bills. Russian troops are coming closer to their goal of taking over Ukraine's Donbas region. Ukrainian forces withdrew from a key city in Luhansk province, saying extending its defense would have led to fatal consequences. Meanwhile, Ukraine will unveil a blueprint this week for the rebuilding of the country. It's expected to cost hundreds of billions of dollars. The European Central Bank is making its most significant shift yet to mix environmental considerations into monetary policy. The ECB says it will tilt its corporate bond holdings toward issuers that demonstrate a better climate performance. Officials plan to decarbonize bond holdings through the reinvestment of redemptions expected over the coming years. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Danny.
Laura, thanks so much. Let's get more on recessionary worries and the sharp moves we're seeing in the bond market. We're joined now by Marcus Ashworth of Bloomberg Opinion. Marcus, let's start here. On Friday, we get that record inflationary number, 8.6% from the Eurozone. We continue to have the commitment from Christine Lagarde of a 25 basis point raise come in 2 weeks. Is the ECB heading towards a policy mistake?
I think it is in a number of different ways. I think it could and should have raised rates already. I think it should get straight on going to zero. I've been thinking that for years, but that's by the by. I think the economy would actually do better with positive rates than it currently is struggling with negative. But, I appreciate they've got a potential recessionary environment enveloping it. We're even looking at the US possibly being in recession for the first half of this year. So we can clearly see with the threat of Russia cutting off gas supplies, it's a very difficult decision for the ECB, but they've got to get on with it. And they're also, at the moment, trialing markets, flying kites and all sorts of various different things for their anti-fragmentation tool, which is a dangerous way of going about it. For the short term, they've managed to get Italian yields back below 4% substantially. I hope that continues. But I think if they think they can last the whole summer with just doing 25 basis points and not producing a proper safety net, I think they may be very sadly woken up to bad news.
You make an important point here, Marcus. It is two fires, two fights that the ECB is trying to fight at this moment. Do they have the tools at hand? I know the details have been scant, but do they have the tools at hand to both tighten financial conditions and make sure the periphery spreads don't blow out?
Brutally honestly, I don't think they do. And I think they know that as well. And I think the market is pretty suspicious of what's likely to happen. I don't think rearranging the deck chairs with the PEP reinvestment is going to be enough. They could possibly unfreeze some of the remaining firepower they didn't quite use by another 150 billion. But all sorts of talks of conditionality and various things they've got to get through, which I don't think will get through a pretty hawkish governing council. To my mind, there's a big risk here that they could fall short on delivering a sufficiently bazooka-like whatever it takes.
Marcus, how would gas being shut off from Russia completely to Europe and Germany, how would that change the outlook for the ECB?
Oh, well, I think we would worry less about, certain things and worry much more about the whole solidity of the continent and the economy. So I think that's all bets are off type scenario. And I think they just got to get themselves in a better pace, that if things don't happen, worst case, that they can then get on and start moving to a better case scenario. And that means sorting out their approach on inflation and at least getting away from negative rates and allowing the ending of QE to be something which can actually last. However, they do have to provide a proper safety net, and that's something which they haven't quite sorted themselves out on. And it's a difficult thing. It's contradictory, perhaps, but they've got to put their own house in order. It's the mistakes of their own making, I'm afraid, for many years.
And totally fair. It does seem like we're in this environment where you need to prepare for that tail risk to become the base case. Marcus, thanks so much. Marcus Ashworth there from Bloomberg Opinion. Now, in the U.S., growth concerns are casting a shadow over Wall Street. Economists are racing to downgrade their outlooks.
We're looking at an economy losing momentum faster than what we anticipated.
Economists have begun to cut their top-down economic forecasts for GDP.
This is a global story.
Input costs have risen substantially.
We're seeing demand destruction in some areas.
The consumer is on somewhat more fragile footing.
We do expect the Fed to hike rates more aggressively.
The Fed has been driving the car looking through the rearview mirror.
The economy is slowing, and the Fed is saying that's collateral damage.
Companies and consumers
need to get ready.
Frankly, we think they can keep going.
I don't think they blink. We did see some pretty notable downward revisions.
We expect more downgrades.
Let's add another smart voice to the conversation. James Athey, Senior Investment Manager at Aberdeen Standard Investments, joins us now. James, it certainly feels like the market has woken up to this. You saw bond yields, 10-year yields falling 25 basis points last week, the biggest 5-day decline since March 2020. The market has woken up to this, but has something changed in your book over the past 2 weeks?
Not massively, Danny, to be honest. This is kind of where we've been expecting that we would find ourselves for quite some time, to be honest. I mean, we are very early in that call in the initial recovery stages of the pandemic. I think we underestimated the fortitude of fiscal authorities and indeed the spendthrift nature of consumers in a lot of countries. But essentially, we've got that massive growth recovery from unsustainable tailwinds. We had these huge fiscal giveaways. We had consumers behaving as if there were no concerns. We had obviously interest rates at the floor, housing markets were booming everywhere. All of these tailwinds have increasingly become headwinds over the last 12 months. And economies, they really do exhibit inertia. Once they are moving in a given direction, they will continue to move in that direction unless an external force acts on them. In past cycles, that external force has been central banks cracking and capitulating at the first sign of trouble, providing liquidity and cutting rates to zero. They cannot do that when inflation is 8.5%. And so I think we're in for some tricky times ahead.
Walk me through then your call, James, for increasing duration right now, because if banks can't blink given where inflation is, at what point does duration start to become attractive again? I know we've seen a bit of it over the past 2 weeks, but give me your long-term outlook there.
Yeah, I mean, it's been super volatile, hasn't it? And that's been the difficult aspect. It's such an obvious story to say, hey, look, inflation is high, central banks are tightening, and therefore who on earth wants to own bonds? But really, you have to consider bonds in the context of alternative asset classes into which you may invest or be invested or no longer want to be invested. And they don't look quite as bad when you compare them to equity markets, which are also highly volatile. But have fallen 20% or 20% plus without any real decline in forward earnings estimates. So if the US is negative 1.5% growth in Q1, negative 2.1 according to the Atlanta Fed for Q2, and yet you've still got top down and to some degree bottom up earnings forecasts suggesting that companies are able to maintain or even grow record margins and grow underlying earnings in that environment, I'm going to suggest that something is up there. So it's been a highly short squeeze driven rally that we've seen in bonds. And of course, we're seeing yields pop up again. But 325, that blow off top we saw up to 350 looked like just that. And I think as we head back up towards a 3 handle in US 10 years, we're going to feel increasingly comfortable that the medium term outlook is very supportive to own duration up there.
I got to pause on this idea about earnings for a second, James. There's a really great Bloomberg story out yesterday talking about the sell side. They haven't touched their estimates. In some cases, that means something like a 300% rally in stocks. They seem pretty unobtainable at this moment. What would it look like in this market to actually factor in earnings deterioration?
It's not going to look pretty. For starters, I think we're about to find out. I'm not sure necessarily Q2 earnings are going to be horrendous across the board. I certainly think some of the more cyclically exposed sectors might see some really nasty earnings numbers, and certainly those companies that have gone into this period highly overvalued, I think may continue to see downward pressure. But I think guidance is going to be absolutely critical. That's a dynamic really that we've seen in the last few earnings reporting periods, is that as much as anything, how CEOs and CFOs feel about their own company outlook has been what's depressed sentiment around the equity market. But if we see earnings, I think the relationship, shall we say, between earnings and GDP growth that we would normally expect to see, there is significant equity price downside without even considering what that may or may not do to multiples valuation that's being attached to equity markets. The fact that we saw equities bounce off the back of yields falling as dramatically as they did on Friday, driven by poor data, I think just shows that still equity markets are stuck in the previous paradigm where Fed liquidity really is all they care about. I think if they think the Fed's going to save them over the next 6 months, they're sorely mistaken. So I'm expecting some pretty weak equity performance in this performance period.
bad news returning to bad news yet again, James. We'll look out for that environment. Again, that Pavlovian urge to buy the dip at Fed coming to the rescue, perhaps that's starting to peter out. James, thank you so much for joining us today. James Athey there, Senior Investment Manager at Aberdeen Standard Investments. And markets continue to rally. Perhaps a Pavlovian dip is there today. I should say for those who are trading futures in the U.S., those are slightly off, down about 0.2% for S&P 500 futures. But here is your picture in Europe. Yields moving higher, up about 9 basis points. Well, coming up later in the program around 8 a.m., we're going to be talking to Alexandra Jackson, Rathbone Fund Manager. We'll ask her as well about the earnings picture. Do markets need to price it in? James Athey says that we normally see significant equity price downside in this environment, that relationship between GDP and earnings. What will that look like this time? We'll dig more into that later throughout the program. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The Boston Pops Fireworks Spectacular is back in Boston, and Bloomberg will make sure you don't miss a second of the fireworks. Music and special appearances by superstar Shaka Khan, Grammy and Tony winner Heather Headley, and The Voice winner Javier Colon, plus Middlesex Fifes and Drums and the Tanglewood Festival Chorus. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
German unions are warning that the country's gas crisis could wipe out entire industries. Let's dig into the story more. Joining us is Bloomberg's Benedict Campbell in Berlin. Benny, so we have this warning from the union head, the top union head in Germany. What sort of industries is he expecting that will be affected from this?
So the industries that are most at risk here are obviously the energy-intensive industries. That's places like cement, aluminium smelters, the chemicals industry. BASF is the world's largest chemicals company, and they are based here in Germany. So sort of the backbone of German manufacturing, if you will, that really is at risk. And these aren't just sort of bumps in the road that this union head forecasts, but rather, in her words, permanently collapsing. The permanent collapse of these industries is what she sort of sees as a doomsday scenario. And obviously, the German government is trying everything they can do to avert that on the industrial side. There's also the consumer side that they're keeping a very close eye on. We've seen energy bills sort of go through the roof at private consumers, both on the electricity, but also on the natural gas side. And the same union person who warned of the collapse on the industrial side said, we might face civil unrest in Germany come those higher bills. We're talking several hundreds, if not thousands of euros in extra costs for people. In the next couple of days, each German household will get a small aid package of a couple of €100, but that certainly won't go far enough to cover the extra costs. So come winter, things could get rather ugly.
And I suppose one of the dates we're looking out for is mid-July, when Nord Stream has its maintenance, something where we might see Gazprom cut down on flows, already cutting down by 60%. And that, of course, has had huge implications for Uniper scrapping its outlook for the rest of the year. Where do we stand there in terms of a Lufthansa-like bailout for the company?
Yeah, you're absolutely right that this mid-July date, the 11th, so that's a week away, that's quite crucial. What should have been a routine cutoff and maintenance, it now looks, we're all staring into that black hole. Nobody knows, will the Russians turn the gas back on after the maintenance? Will they turn it back on at even more reduced levels, or will they keep it turned off? And at this point, nobody knows. And so the German government is frantically sort of working on plan B, plan C, to try and get gas from other places. Uniper, the utility that you mentioned, they are the biggest gas importer into Germany, and they've been hit incredibly hard by this. Olaf Scholz, the Chancellor, came out over the weekend saying that the government obviously knows a thing or two about bailing out companies, given the Corona experience. You mentioned Lufthansa. So we don't know exactly what they're planning. It might be extending loans. It might be actually taking a stake. There was a story from my colleague Isis Almeida over the weekend talking about this trend of renationalization of entire energy industries. So 30 years after the market was liberalized, we might see this being turned upside down again, and countries, governments being forced to take stakes again in companies, from EDF to Uniper to others, simply because these companies are teetering on the brink of bankruptcy.
Perhaps that's more palatable for the voting base than what Bloomberg opinion Andreas Kluth suggesting that you get a speed limit on the Autobahn. Not too sure how that one would go over. Benny, thanks so much for breaking it all down for us. Bloomberg's Benedict Campbell there. Now, to the rest of Europe, the war continues in Ukraine, and the Ukrainian government and global policymakers are also looking to the future, trying to mobilize countries and multilateral institutions, looking ahead to reconstruction that will be necessary. Of course, this meeting taking taking place in Switzerland. Let's bring in Bloomberg's Maria Tadeo, who's there at the Ukraine Recovery Conference in Lugano. Maria, so that's looking towards the future. Obviously, that conversation is happening where you are in Switzerland. But what is the here and now? Where do things stand in Ukraine and the battles that continue to wage on?
Well, Danny, this is why I love the fact that I am coming right after a segment on the German economy and what could happen in the next few months if they try to build up the storage, and of course ahead of the winter, because that is really the tension that we see play out in a conference like this. Of course, I want to keep it positive. They want to show that symbolic support for Ukraine. They still say, all of the governments and officials, remember the head of the commission is also here in Lugano meeting with the Ukrainian delegation, that Europe will stand with Ukraine against Russian aggression for as long as it takes. But then there's, of course, the economic reality that is kicking in, and we're seeing it play out in Europe pretty much every day. Is those bills, is a concern about the winter, potentially gas being cut off. All of this makes a conference like this a place that at times feel slightly bipolar. We're looking at potentially billions of euros into this reconstruction. Just to give you a few numbers, in terms of the short-term reconstruction, the numbers floated are about 100 billion euros. The overall package can go all the way from 500 billion euros to yesterday was suggesting 1 trillion. But the real question, and nobody has an answer for it for the time being, is how does Europe weather this double storm? One, a war that's happening right across the center of Europe, and then another one, of course, the economic fallout that will no doubt come in the next few months.
Maria, that's a very good point. It is a concern over the economy in Europe. How prevalent is that conversation, or is it all just about talking about commitments? You address the economic woes later.
Yeah, and look, it's incredibly difficult because they want to get the tone right, but this is a crude conversation to be having. On the one hand, we have seen that Europe continues to provide financial help for Ukraine. We've also seen that the Ukrainians have said they may need more cash on the short term. A war is incredibly expensive. They want to stay competitive. And once again, President Zelensky, who, by the way, also addressed his conference today, repeating that Ukraine is not going to give up on anything, that Ukraine will not fall into a dictated peace by the Russian Federation. But I think for Europeans, they try to keep an eye on two balls that at times are difficult to put together. One is try to shield their own economies, but they depend incredibly on Russia. We had that note last week from Deutsche Bank Research saying we're now incredibly concerned about the European energy picture. A lot of market participants now beginning to think that at one point gas will be cut off, and that could send Italy, but also Germany, into recession. And on the other hand, trying to keep Ukraine and try to help them win this war. And what is clear now from the Ukrainians is that they still believe the best option that they have is to continue to fight. If they give up now, Russia will use this as a platform to further make inroads in their land. And that is, of course, something that for them is simply a no-go.
Maria, thank you very much. Bloomberg's Maria Tadeo there at the Ukraine Recovery Conference in Switzerland. And just on that note of the concern about the economy, we see it today. We see natural gas up another 8.6%. Is this a market that's preparing for what Habeck, the German finance minister, calling a Lehman-like moment if indeed we do get gas cut off for the region? Something that also might change the outlook for the ECB as well as they tiptoe to rate hikes as they're concerned about the economic fallout. I should say Nomura also calling for a Eurozone recession. Coming up, we discuss private equity. We'll be speaking with Charles Hayes from Freshfields. That's next. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Markets. Bloomberg is now reporting that Credit Suisse is cutting dozens of frontline roles. It's an overhaul of its investment bank in Asia. This comes as the lender grapples with losses and a weakening economic outlook. For more, let's bring in Bloomberg's Michael Moore. I mean, Michael, Credit Suisse can't catch a break, but how much of this restructuring, is it something necessary that shareholders see as necessary to get things in line and get to this period of recovery at Credit Suisse?
Yeah, Danny, I think it's partly a Credit Suisse specific story, but it's partly a regional story here. You know, we had reported that Credit Suisse was looking at potentially global job cuts, and they had pledged to accelerate some cost cuts that they had promised last year. A lot of that is coming through the technology, but, you know, it does look like job cuts are going to be a part of that expense reduction. And that brings you to the Asia side of things. I think there has been a slowdown in activity there, both on the wealth front and the investment banking front. Credit Suisse last month warned of another loss coming in the second quarter, and they specifically called out the slowdown that they've seen in Asia. And I think they're not alone in that. Other banks have seen that as well. And, you know, that's a region that's long been, the banks have been investing in that for the promise of future activity. But the more that gets pushed out, the less it makes sense to have big staffs waiting around for that activity.
You know, I know we're reporting it's the deal making, it's the trading team, it's investment banking, but as you've been describing, it's this region as a whole that's a problem with asset management as well. Talk us through the pressures that Credit Suisse and global banks are dealing with asset management, and could we see cost cuts to come in that sector?
Yeah, I think this will not be the last we see of job cuts, you know, at Credit Suisse. But, you know, we may also see it across the industry. There was a serious talent war last year when you had a ton of activity, and we've seen a sudden stop on the equity issuance, in some pockets of debt issuance. Mergers have held up reasonably well, but you could see a slowdown there as the credit markets get a little tighter. So this may be just the beginning of kind of a pullback in the expansion we saw last year.
Michael, we also have the FT reporting overnight that the ECB is looking at a way to prevent banks from getting a windfall profit from some of the subsidized loans coming from the pandemic, those programs there. Walk us through what we know.
Sure. So this was, you know, long seen as a potential unintended consequence of these pandemic loans to the banks to try to keep credit flowing. And it wasn't much of an issue when you had negative rates at the ECB. But as those rates start to go positive, then you have the potential for a carry trade there where the banks use those loans and just park money, earning a positive return. And that's obviously something the ECB doesn't want. They want the point of these loans to the banks was to encourage lending to the real economy. And I think this is just the ECB looking to ensure that happens. We're still a ways off from those positive rates, but with more investors seeing that coming down the pike either this year or next year, that's something that the regulators have to keep an eye on.
When it comes to the mix for European banks, Michael, it's a really interesting time considering that, yes, rates are rising. Perhaps that helps with net interest income. But at the same time, you described some of the deal activity, certainly volatility in markets hitting banks. What are we going to expect for this year as we head into the second half?
Yeah, I think it'll largely come down to how the trading desks hold up. I mean, you mentioned the trade-off between higher rates and slower investment banking activity. In the first quarter, there was a lot of volatility in the markets, and that actually helped European banks. Many of them put up really strong trading results. In the second quarter, there had been a decent amount of optimism, but in the last few weeks, we have seen more volatility in the credit markets. How the banks hold up in that environment, I think, will be kind of the swing in whether this is a solid year for them or not.
Michael, thank you very much. Bloomberg's Michael Moore there. Now, as Michael mentioned, there has been a slowdown in some M&A, global M&A volumes. They've fallen nearly 17% in the last year. There's surging inflation, hawkish central banks, all of that fueling a slowdown in deal making, banks stoking the fire amid a pullback in lending. Let's dig into it more. Joining us is Charles Hayes, Global Co-Head of Financial Sponsors Group at Freshfields Druckhaus and Derringer, who joins us on the set in London. Now, Charles, thanks so much for being here. So 17% fall, that's Bloomberg data, I should say, year over year. Is the end of easy money ushering a new regime when it comes to deal making?
Well, let's remember that 2021 was a record-breaking year for private equity, both in terms of deal values, deal volumes, and in terms of fundraising. I think it's entirely reasonable now to expect a little bit of revisiting the playbook, and I think that now we're going to see our private equity clients looking a bit to see how they can leverage the opportunities in this period of volatility. But let's not forget, this is what private equity clients do best, is deploying capital in asymmetric markets. It won't be long before we see them back to business as usual.
So maybe it's more back to fundamentals. If last year was indiscriminate, everything's cheap, buy it up.
That's absolutely right. I think a period of inflationary pressure, maybe some interest rate rises to come. Some are talking about a trend to 3%. That's perfectly normal. We've been here before. Private equity can deploy capital very well in those environments, generating significant returns. That's what our clients are telling us at Freshfields. That's what we expect to see.
So that's the positive. But I do wonder if there's anyone that looks at last year, looks at these high valuations that everybody has been paying and say, okay, markets are starting to fall rather. I'm feeling that call, perhaps a buyer's remorse.
There will be assets for sure in certain sectors that are a bit more exposed. But we see sectors such as life sciences, healthcare, financial services. These are sectors which are well placed to weather this inflationary pressure. They're well placed to weather potential interest rate rises. There'll be a lot of focus on operational management. There'll be a lot of focus on buy and build strategies. There are plenty of things that a private equity buyer can do with those assets to continue to leverage those returns. And don't forget, they can just hold them for slightly longer and let it play through.
Right, which I have to say, I've seen a lot of public market players express a lot of angst about this. So the only reason that private equity hasn't seen valuations come down as much is because they're not marked to market. Do you think that that criticism of the industry is fair, that it's almost one investor, Cliff Asness, put it as volatility laundering, that is just this facade of lack of volatility?
You're always going to see a bit of arbitrage between those public and private markets, for sure. But certainly what we're seeing is that there are opportunities in there, and there's always the opportunity for mark-to-market with a private equity portfolio. So I think that criticism is unfair.
Well, speaking of public markets falling, how many funds are looking now at snapping up many more take-privates, going towards that P2P again with bear markets throughout global equities?
Undoubtedly. And with a 12% drop in sterling as against the dollar, that's a great opportunity for international investors. And we're seeing a huge amount of inflow into public markets, take-private activity. There's more of that to come for sure.
But what is going on in the UK market? I know I'm asking that a little bit facetiously, but you have Reckitt Benckiser shelving their sale of a baby formula. You have Walgreens Boots abandoning their sale of Boots. Is this a UK problem, or are these idiosyncratic instances of deals falling apart?
in these markets, you're bound to see some volatility. This is going to correct over time. What we're seeing there, I think, is some of the situations you've described, Danny, is just expectations as to value between buyer and seller need to settle. That'll take a bit of time. But this volatility, again, is perfectly normal. And again, some private equity firms will find that there are great opportunities to deploy capital there.
What about in terms of cross-border M&A? How does that fare in these types of volatile periods?
Again, there are great opportunities to leverage those different markets. The challenge there for some private equity firms is going to be some of the regulatory intervention that we're seeing. And that's not unique to private equity. That's across the board. Whether it be with the US, the DOJ has gone out on the record with a bit of skepticism about private equity. But again, CMA, European Commission, a bit more open to that level of investment. So I think that just is something that needs to be looked at carefully.
Yeah, I did see Bloomberg reporting that the EU is trying to hammer out a draft agreement on rules, basically putting more scrutiny on foreign firms that are trying to buy up local companies. Obviously, there's a lot of volatility, not just in the markets, but geopolitics at this moment. How much is the political affecting the environment?
That's exactly the right way to look at it. Nothing has changed here in terms of the regulatory framework. There's no new law here. This is just an enhanced regulatory scrutiny driven by political intervention, national politics, a domestic agenda. But from a globalization perspective, nothing has changed.
Is it warranted, this extra scrutiny? Do these European markets, UK markets, do they have an issue with foreign buyers coming in?
Not especially, and the fundamentals have not changed.
Okay, so perhaps, again, it's just the politics there at this moment. But has it led to any any pullback, any hesitancy in deal making? Because we are seeing the CMA, others place more scrutiny.
I think people are having to go back to the rule book, back to the playbook, and think quite carefully about their strategies and their tactics. And they're engaging early, and certainly what clients are telling us is they will front load a lot of the work they might otherwise have done later to assess what the regulatory framework looks like for that particular transaction. But it just means putting more weight effectively on the buyers to do their homework.
So we talked about some of the sectors that are attractive, ones that will be robust through this. One sector that has felt the pain is certainly tech, be it in the public markets or you look at the Tiger Cubs, for example, who gobbled up private tech, now feeling the pain of that valuation rethink. When it comes to tech, how big of a drop in valuations are we expecting in deal flow? Is it outsized, in other words, compared to the market as a whole?
Look, the tech sector is huge, right? And there are always going to be opportunities within the tech sector. Certainly, we've been focusing with our clients on sectors that are, whether it's life sciences, healthcare, supply chain, energy, stability, security, across the board. And I think what we'll see there is just people looking for greater opportunities across the broader spectrum. But the tech sector is huge. And so I think looking at it on a macro level, certainly our clients will be looking for the individual opportunities.
You mentioned energy securities. There does feel, not necessarily in private equity, but just the asset management industry as a whole, a rethink when it comes to ESG. You have Frankfurt offices being stormed by different regulators. You have, Goldman Sachs discussing this. There are many, many asset managers who say, okay, perhaps we need to rethink this, and clients thinking it as well. Are we entering a period where there will be a reckoning when it comes to ESG, when it comes to greenwashing?
I certainly hope not. The ESG story has been a great one for private equity. It's a great opportunity to deliver real value to their limited partners and to their investors. For many private equity clients that we advise, it's a way of demonstrating real value in the ESG narrative, whether it is supply chain, as you say, or across the whole spectrum. So I certainly hope not, but I can see that some might want to use it as an opportunity to revisit that strategy.
Right. Charles, thank you very much for joining us. Great to have you with us. Charles Hayes there of Freshfields. Now, as we get closer to the end of an hour with the U.S. offline, happy 4th of July, by the way, if you're celebrating today, we continue to look at equity markets in Europe pushing higher. Cash trading, of course, closed with U.S. equities and treasuries as well. Futures are open in the U.S. We're looking at a slight decline. They're down about 0.2%, but it is the economic picture, the energy picture, which is gripping Europe right now. German two-year yields, those moving higher by nearly 10 basis points after a very strong rally last week. But how much of that is a head fake? How much of that was just being opportunistic after, again, we've seen yields very high? Is the era of Tina finally over? Barclays certainly thinks so. They say there is an alternative. Now that alternative exists in bonds. Of course, Not seeing that quite today, again, as we look at selling in European bonds. Meanwhile, we're looking at iron ore dropping 4.5%. Goldman Sachs cutting their outlook, saying it could be $90 in the medium term, $100 when it comes to the longer term picture. That over China, not only are there concerns about growth, not only are there concerns about housing, but at the same time, there is excess surplus when it comes to iron ore. Excess surplus, that's beginning to become the story of the second half. Now, coming up, you saw it there, a preview of the Boston Pops fireworks spectacular marking Independence Day. This, of course, images from 2019, but I'm sure this year will be just as spectacular. We'll have that for you next. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
keeping you up to date with news from around the world. With the first word, I'm Laura Wright. Experts are calling it the biggest cybersecurity breach in China's history. Unknown hackers claim to have stolen data on as many as 1 billion residents in China after breaching a Shanghai police database. The person or group has offered to sell more than 23 terabytes of data for 10 Bitcoin, or about $200,000. In Turkey, the inflation rate in June hit 79%. That was slightly less than expected. Global shocks in food and energy markets added to pressures from currency depreciation and low interest rates. Inflation in Turkey has been in the double digits almost continuously since 2017. The crypto lender Volt has joined several of its rivals in resorting to last-ditch measures to survive the market rout. The Singapore-based company has frozen withdrawals and hired advisors to explore a possible restructuring. Volt says there has been more than $197 million of customer withdrawals since June the 12th. Soaring rent growth in London's premium districts is set to slow in the second half of the year. The cost of living crisis is curbing the amount that tenants are able to pay. According to the broker Savills, rents rose the most in more than 2 decades in the first 6 months of the year. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Danny.
Laura, thanks so much. 2022, it's been a big year for Boston. It is the bicentennial celebration of Boston becoming Massachusetts' first chartered city, tricentennial of the first printed map of Boston, and 40 years ago, the iconic TV show Cheers debuted. Here's a look at some of the Boston milestones ahead of tonight's Boston Pops Fireworks Spectacular.
This year marks the 200th birthday for the city of Boston. It was back on February 23, 1822, that the Massachusetts state government moved to redesignate the rapidly growing town of Boston to the city of Boston. It was an acknowledgement of a 40,000-strong population that had tripled since the end of the Revolutionary War. The petition was ratified in March of that year and became official on May 1st.
Although the vote was 2,700 in favor, about 2,080 against. Some wanted to keep the old system.
Today, its population has swelled to almost 700,000 people, making Boston the most populous city in all of the New England region. This bicentennial isn't the only milestone being celebrated by the city in 2022. This year also marks the tricentennial of the first printed map of Boston, and we have Captain John Bonner, a navigator and shipwright by trade, to thank for that.
In the 1760s, a new map was made using Bonner's map, and essentially they just sketched in the new street.
Captain Bonner's mapping of the streets, churches, and public buildings, along with the detailed locations of waterways, docks, shipyards, and wharves, now provides one of the most comprehensive representations of what Boston looked like before the Revolutionary War. 2022 also is a big year for the city's newspaper of record, the Boston Globe. 150 years ago, on March 4th, 1872, the Globe published its first edition. Back then, a copy would set you back 4 cents, and the front page included a current events section where writers could vent about whatever was bugging them. Apple price inflation was a frequent topic back then.
There already were a lot of newspapers in Boston. There was the Boston Post, which actually was the largest paper in New England. The Globe really became initially the newspaper of the rising Irish immigrants.
Over its history of keeping Bostonians informed for 15 decades, the Globe has won 26 Pulitzer Prizes. And lastly, we raise a pint for the bar where everyone knows your name. Cheers! 40 years ago, the groundbreaking TV sitcom aired its first episode in September of 1982. The show would last 11 seasons, win 28 Emmy Awards, and make Ted Danson, Rhea Perlman, Woody Harrelson, and Kelsey Grammer household names. So as you can see, 2022 is a big year of anniversaries for Boston, and surely there will be many more to come.
Perhaps a little early in the day if you're in the U.S. to raise your glass, but perhaps it's allowed today because the Boston Pop Spectacular Fireworks, it is back on, live on the banks of the Charles River for the first time since 2019. Also back on the banks of the Charles River is Bloomberg's Romaine Bostick, who's there now with a preview for us. Romaine, am I seeing this right? 40,000 people set to attend?
I think you need to sort of multiply that by 10, Danny. It's going to be as many as 400,000 people packed on the Esplanade here. 400,000, Danny. This is huge. I mean, look, this is actually one of the bigger celebrations, July 4th celebrations, in any of the major cities here in the United States. And what other place is more fitting than a place like Boston, which is so emblematic of what was going on during those revolutionary times, that Declaration of Independence, which we know came officially on July 2nd and then, of course, was officially adopted on July 4th. But this is just such a rich city, just that revolutionary spirit and a real patriotic spirit here.
A real patriotic spirit, and of course, perhaps that I should multiply by a few factors as well, given that it's the renewed Boston Pops after COVID. What does it mean for this city? What does it mean for tourism emerging out of this COVID period?
Well, everyone we talked to, they're so happy to have this back. The last one that was here on the Esplanade was in 2019. It was disrupted the last couple of years because of the pandemic. This is a city that really just wants to get back to normal. And you're starting to see that as you walk around. You're seeing more businesses reopen. You're seeing those offices start to fill up. This big event, and we're going to talk a little bit later with the mayor of Boston, the new mayor, Michelle Wu, and kind of what they're doing to sort of bring these big live events, these big arts events back to Boston. Everyone you talk to is so excited to have this. I don't think you understand. The people who live here, who are used to coming to this, who've been coming to this for 40, 48 years really now, they're used to it, and they want it back, and they were really bummed that they didn't have it the last couple of years.
Romaine, talk to us about who David Mugar was, who he is, and why he's important today.
Well, he's basically responsible for what we know as this fireworks spectacular today. Remember, the original show was just kind of a small sort of classical concert that Arthur Fiedler put on. And it was David Mugar who sort of came back in the 1970s and said, we should really amp this up. And he brought in the 1812 Overture, this sort of bombastic finale to the show. He added fireworks, live cannon fire, church bells, and it just became this much more dynamic show. He was also a big part of why the show ended up on television. He really sort of worked with television broadcasters, not only here in the Boston area, but nationwide to really get this out there. And it's one of the reasons why it's become so big and why it's become so popular, and more importantly, why it's become one of the most watched fireworks shows in the entire country.
Romaine, really excited to see you walk us through all of the spectacular later today. Romaine Bostick there in Boston. Of course, be sure to tune in. It'll be tonight, 8 p.m. New York time for the Boston Pops Firework Spectacular right here on Bloomberg Television. Maybe I'll even stay up for London time to watch that one. Look, Middlesex County volunteer fifes and drums are playing. It's certainly one not to miss. Now, coming up on the program, we're going to be speaking with Alexandra Jackson, fund manager at Rathbones. It's a complicated time for investing in Europe. You're looking at inflation hitting record highs. There's concerns about earnings. How do you position for all of it? Will equity markets continue to slump as we go from pricing in a recession, from multiples being the ones that get hit, to concerns about earnings? Can companies hold on to that pricing power? What does China mean for the growth picture? We'll dig into all of that and more with Alexandra on the program to come. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome to a special edition of Bloomberg Markets. I'm Danny Berger. It's 1 p.m. in London, 8 a.m. in New York, and 8 p.m. in Hong Kong. Happy 4th of July. U.S. markets are closed for the holiday. Here's where we stand in Europe this hour. Of course, volumes are lighter because of that holiday, but it is still dip buying continuing. Up nearly 1% in Europe. That follows the rally of last week. But perhaps what's helping us a bit here is the fact that we don't have cash trading in U.S. Treasuries. It really has been that yield story that's dominated the picture in equities. Yields moved lower last week. Pretty remarkable in the U.S. It was the biggest decline of the 10-year yield over a 5-day period since March 2020. That allowed equities to rally. We are seeing a bit of a reverse of that when it comes to Germany. Your 2-year yield, front of the curve, that is higher by nearly 10 basis points. Did the rally in bonds in Germany go too far, given that the gas picture, the gas situation, will it be shut off from Russia? Volumes already declined 60%. If it gets shut off further, what does that mean for the region? Also, growth concerns still in the picture. That belies the fact we're seeing some of those risk assets rally, but iron ore, a really clear indication of where the growth concerns stand. Down nearly 5% today. Goldman Sachs, they've downgraded their price target for iron ore. They say it could go to $90 in the medium term, given just how high stockpiles are and that the Chinese recovery, it has not gotten back into full swing. But Bitcoin rallying up nearly 2%, 1.75%. It was down earlier in the morning. Still, though, unable to get back to that 20,000 level. Well, let's get you to some of your other top stories around the world. With the first word, here's Laura Wright.
Thanks, Danny. The U.S. ambassador to China has called on the foreign ministry there to quit spreading what he calls Russia's lies. Nicholas Burns told a forum that he wished the Chinese foreign ministry would stop accusing NATO of starting the war between Russia and Ukraine. Burns also said Chinese officials falsely accused the U.S. of having bioweapons labs in Ukraine. Meanwhile, President Biden reportedly may lift some of the Trump-era tariffs on Chinese goods soon. According to the Wall Street Journal, the president could announce his decision this week. Treasury Secretary Janet Yellen has called the tariffs a drag on the economy, but others in the administration see tariffs as leverage to get concessions from China. More UK firms than ever before are expecting to raise prices in the next 3 months. That's according to a survey from the British Chambers of Commerce. The findings suggest the highest inflation rate in 4 decades is likely to climb further as firms pass on higher energy, fuel and wage bills. Airbus is running behind its 2022 goal for aircraft deliveries. Bloomberg's learned the company handed over fewer than 300 planes in the first half of the year, well behind the 12-month target of 720. Supply chain issues involving staffing and raw material shortages are holding back deliveries. Airbus said last month that 20 planes could not be shipped because they didn't have engines yet. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Danny.
Laura, thank you so much. European natural gas is extending its rally today, rising to the highest level in nearly 4 months as supply concerns deepen, especially when it comes to the Russian flow through to Germany. For more, we're joined now by Bloomberg's Eddie van der Walt. So, Eddie, I know we're looking at this mid-July date when Nord Stream 2 or Nord Stream has some updates to it. Does that mean Gazprom will use that period as one to turn off the taps? But of course, this comes after we looked at Europe trying to fill up storage fast. Where do we stand at the moment?
You know what, Danny? I think what we are seeing as that demand in Europe is coming forward a lot. I think usually these are the sorts of prices that we see, late in the autumn, early in the winter. Then you're expecting prices to ramp up and demand to ramp up significantly. But I think what we're seeing here is that traders are very worried about this winter, and for good reason, because drawdowns were significant at the end of last year. But I think what we're seeing is they're getting gas as fast as they can from everywhere. And we've already seen a significant amount of inflows this year, putting us on course, for where we were previous years, where inventories are concerned, despite the fact that we had those really big drawdowns over the winter.
How close are we, Eddie, to that level where inventories are the same as prior years?
I think we're just about there. We saw really fast inflows from the end of March to the present period. And I think we saw more or less 30 percentage points of fill up in European natural gas capacity. So we saw a really quick inflow. Now that's steadied a little bit, and it's slowed, in fact. And I think that's because the Russian gas is not, we're not seeing as much Russian gas coming in. And the problem is that you can fill up as much storage as you want. If you don't have a continuous flow over the winter, we're going to be in trouble in Europe, right? So I think what Europe is trying to do now is get all the gas that they can, fill up the storage, but then also look for other sources, right? Be that LNG or coal or, maybe even using more nuclear power. And I think all of those sources will be very important as we go into the winter.
Eddie, that question of will we have inventory when we get to the winter, has the union chief in Germany warning that multiple industries could collapse because of it. It has Habeck over the past couple weeks warning of a Lehman-like moment. What would be the implications if Europe can't find alternative sources of fuel come wintertime?
Yeah, they were talking about shortages. They were talking about, the utilities will suffer. The glass and chemicals and aluminium industries, those are 4 industries that were specifically mentioned. All of those will suffer because, this is a direct input into those industries. But those industries are upstream and used by a lot of other industries. If you can't get, high-end glass and you can't get aluminium, you can't make new cars. If you can't get chemicals, you can't make plastics, you can't make fertilizer. You can't make fertilizer, you can't grow food. So the knock-on implications for the European industry as a whole is significant. And, I don't think anybody can foresee where this will end. But the good news is storage is filling up fast. And as long as that's the case, we have this summer to think of other ways to get us out of that trouble situation.
Eddie, both glass half full and half empty. We appreciate that, certainly. Eddie Vanderwalt from Bloomberg MLive's team. Now, all of that has been feeding into inflation. Inflation hit a record high in Europe. The ECB preparing to hike, but where does it all leave investors? Let's bring in Rathbone's fund manager, Alexandra Jackson, for this. Alexandra, is the market pricing in accurately this potential further energy crisis when it comes to natural gas?
Hi, Danny. Thank you. I think we're going a long way in certain areas, particularly in the UK, where actually UK assets are now trading not only on a discount to their historic levels, but also to the US, to the Eurozone. We also see that most UK assets are trading at or around the kind of typical distress levels that we've seen recently. So that gives you a really nice kind of cushion. The gas, the German gas situation is certainly something we need to, really be keeping a close eye on. As Eddie said, there are a lot of knock-on impacts from that. But if you are looking for an area where valuations are already pricing in a huge amount of bad news, you could definitely do worse than look in the UK.
Does that mean you want to jump into that market, Alexandra? Have you?
Yeah, we're selectively, very selectively topping up a few things that we already own, I guess. I don't think people want to make many big moves at the moment. I don't sense there's much appetite for that at the moment. I think, maybe over the summer as liquidity softens a little bit, we might see markets grinding a little lower. We've got to also work through these, kind of mid-July trading updates. We'll see a lot of those in the UK mid to late July. And we're going to hear from companies, about current trading, where most of them are reasonably sanguine at the moment. But the key will be, what they say about the outlook. And we've seen, more and more really cautious commentary creeping in, which, makes sense. So that'll be really instructive, I think, and that will definitely help investors to, to work out where we are in terms of wage inflation. I hear signs from particularly some IT companies that software inflation might be topping out. Inventory is something to look at as well. But we need that confidence.
I find, Alexandra, that inventory question, I think, is fascinating. We've seen it with the retailers in the U.S. This idea that they've stockpiled inventory because of the supply chain issue, and now all of a sudden consumer demand is shifting. How big of a problem is this for the retail sector?
Yeah, I think it could definitely be a problem for the retail sector. This bullwhip effect where the retailers are stocked with too much inventory, you can see it now in new orders, which have tracked down for the manufacturers. So we're pretty light on retailers in general, some specialty retailers for sure, that we would be happy owning here and where valuations have really been compressed quite significantly. But generally, I think we'd be happy to avoid most of the retail space.
It will be interesting to see how many more warnings we get on some of these earnings calls. Rob Arnott of Research Affiliates saying that CEOs can't act surprised in this current environment if we get a recession, that they need to be preparing for it now. They need to get conservative because, again, if they say they're surprised by a recession, he writes that they'll essentially be laughed at in their face by their shareholders. Do you think that's right? Are you expecting to see CEOs get really conservative for this corporate earnings season?
I think the risk is definitely there that they want to do that. It kind of feels right when you're staring down an environment that is so uncertain, where certain lead indicators are contradicting other lead indicators. It's very hard to kind of divine the future from that. So, the kind of the incentive is there for CEOs to get very conservative, isn't it? The other thing we've seen actually in the UK particularly is quite a lot of CEOs and CFOs and COOs, they're moving on. So a lot of resignations happening. For me, the last time when we felt this was kind of 2008, 2009 time, when people just, were looking and seeing a lot of uncertainty and thinking, I don't think I can go through this again. So that's an interesting clue for me as well.
Alexandra, I really want to end here because while we're busting cliches in this market, you write about this tendency for managers to complain that, a lot of the investors that we have currently, they weren't in the market 40 years ago. They don't understand the current inflationary environment. Why are they wrong to bemoan that?
I hear that a lot. Okay, so maybe we weren't investing in the 70s, the 60s, whatever. But markets move so quickly now. I just don't think a lot of those environments are, hugely relevant anymore. We can learn from history. We can learn from our mistakes. The data is available. We can pass this and understand it.
All right. Ending there with a dose of reality from Alexandra Jackson. Thanks so much for joining us, of Rathbones, of course. Now, coming up, we're going to discuss the Tesla story. Tesla deliveries dipping in the quarter, breaking a 2-year streak. We're going to have details for you next. Of course, U.S. markets are closed, so we're not going to get that instant reaction from over the weekend. But we are looking at futures softer today. Your U.S. futures down 0.3%. Meanwhile, we're looking at European stocks. Those are able to push higher, but again, volumes are off. They've been about 30% off for this time of day. Perhaps, though, they're able to rally given the fact that we are looking at yields. That come down in them is reversing today. German 2-year yields, those are up by nearly 11 basis points. The rally we saw in the front end of the curve in Germany last week was remarkable, about 60 basis point drop over the past 2 weeks. Is this a market that now, though, is rethinking that? Can the ECB pull back, just do 25 basis points later this month, given inflation continues to be a problem, and inflation continues to be a problem given natural gas higher by about 9% this morning. There's concern that Nord Stream, when it goes under maintenance later this month, that flows from Russia will be cut off. Meanwhile, iron ore down more than 4.5%, a concern of growth there when it comes to China, and Goldman Sachs saying that stockpiles are high. Meanwhile, Bitcoin, that is moving higher, still though unable to break the 20,000 level. We'll continue the market conversation next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Boston Pops Fireworks Spectacular is back in Boston, and Bloomberg will make sure you don't miss a second of the fireworks. Music and special appearances by superstar Shaka Khan, Grammy and Tony winner Heather Headley, and The Voice winner Javier Colon, plus Middlesex Fifes and Drums and the Tanglewood Festival Chorus. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
Welcome back to Bloomberg Markets. Tesla's Elon Musk told Bloomberg there are still unresolved matters about his bid for Twitter, and he sees a recession as likely. Last month, he spoke with Bloomberg's editor-in-chief, John Micklethwaite, from the Qatar Economic Forum in Doha, powered by Bloomberg. Take a listen.
With respect to the Twitter transaction, there's a limit to what I can say publicly, given that it is somewhat of a sensitive matter. So I will have to be measured in my responses here, such as not to generate incremental lawsuits. Unfortunately,
that seems to be a risk you sometimes manage to overcome.
Yes, deposition minimization is, I think, important.
Have Twitter given you enough information?
Well, there are still a few unresolved matters. You've probably read about the question as to whether the number of fake and spam users on the system is less than 5%, as Twitter claims, which I think is probably not most people's experience when using Twitter. So we're still awaiting resolution on that matter, and that is a very significant matter. So we're awaiting resolution on that. And then, of course, there is the question of will the debt portion of the round come together, and then will the shareholders vote in favor? So I think those are the three things that stand in the, that need to be resolved before the transaction can complete.
What about the general state of the economy? Does that weigh on you when you think about this? I mean, you just described it. You have a super bad feeling about the economy. Are you still in that position? I just said to you earlier, Joe Biden has just come out and said that a recession in America is not inevitable. How do you feel about the economy?
Well, I think a recession is inevitable at some point. As to whether there is a recession in the near term, I think that is more likely than not. It certainly isn't. It's not a certainty, but it appears more likely than not. And what do you think?
I'm with you. I agree with you. I think it's more likely. Can I ask you one particular thing to do with the Twitter bid, which is, you are one of the biggest and fastest growing investors in China. Tesla, you've talked about it being a third of your sales going forward. You're now buying Twitter, the kind of public forum for free speech. The Chinese historically don't tend to be very enthusiastic about free speech. Are you worried about whether you can keep those two particular horses running? Is buying Twitter going to get you in trouble with the Chinese?
Well, Twitter does not operate in China. Yes. So, and I think China does not attempt to interfere with the free speech of the press in the U.S. As far as I know, because I assume you're not under pressure at Bloomberg from China. So I think there's. I don't think this is going to be an issue.
And in terms generally of that issue of freedom of speech and Twitter, you've talked about Twitter making it even freer and letting more people onto it. Is there a limit at all to who you think should be allowed onto Twitter?
Well, my aspiration for Twitter, or in general for the digital town square, would be that it is as inclusive, in the broader sense of the word, as possible. That it is an appealing system to use. So, I mean, ideally, I'd like to get like 80% of, let's say, North America, and perhaps, I don't know, half the world or something, ultimately on Twitter in one form or another. And that means it must be something that is appealing to people. It obviously cannot be a place where they feel uncomfortable or harassed, or they'll simply not use it.
Tesla CEO Elon Musk there on Bloomberg TV. And let's get to a man who surely is tired of us asking him questions about Twitter and Elon Musk. It's Bloomberg's Alex Webb. But Alex, going to save you this time. Let's not talk about Twitter. Let's talk about what we got over the weekend. We had Tesla quarterly sales coming in over the weekend, or deliveries rather, disappointing. How big of a disappointment was it?
Well, it was, they had expected, and investor community analysts had expected a drop-off because the factory in Shanghai was not operating for several weeks. We know all about the big lockdowns in Shanghai, and of course Tesla was affected by that. The slight issue was that it was even fewer deliveries than had been telegraphed and had been anticipated. So clearly a certain amount of cause for concern. The comments since then seem to have been broadly optimistic. The factory has been going gangbusters, we hear, since then. So as long as the demand continues to be there, then, you know, the issues of supply tend to be just a blip rather than a long-term concern.
I guess, are those issues of demand there? Because we've heard from Elon Musk. He talked about with John Micklethwaite, that interview we heard from prior weeks there. We've heard about him cutting staff. So where is the concern coming from then?
Well, he had said that this quarter was likely, so before these production issues, was likely to be flat compared to the directly preceding calendar quarter, not a year earlier. It was up quite substantially still on a year earlier. Now, that perhaps gets at some of those issues of demand. We have generally seen maybe there's some sort of correlation between people who buy Teslas and performance of crypto, for instance. These are sort of relatively macro factors that can affect demand for those vehicles. It is still trading at a hefty premium, or hefty multiple. It trades something like 59 times forward earnings. You compare that to the established car makers who tend to trade at less than 10 times forward earnings. There's a lot of enthusiasm still around the stock, and the 12-month target price is still, I think, $150 above the 600 something is that right now.
I find this so interesting. What should we be comparing Tesla to when it comes to valuations? Who are its peers?
I mean, ultimately, Tesla's slightly dislocated from the reality of the automotive industry. Sometimes, the car makers that tend to be trading right up there that aren't in the electric space, think about something like Ferrari, right? It's framed itself quite well as a luxury brand, comparing itself to the like of Kering and those guys. It trades at about 35, 40 times forward earnings. So maybe that's a place where Tesla ultimately settles. Don't forget, Tesla already makes a lot more cars in any given year than Ferrari does. So nothing in the old automotive space is quite directly apples to apples.
Alex, thank you very much. That is our Alex Webb giving us all the latest on Tesla. Now, coming up, we turn back to the story in Ukraine. Ukraine will unveil a blueprint this week for rebuilding the country. We're going to go live to the Ukrainian Recovery Conference in Switzerland. Our Bloomberg's Maria Tadeo standing by for that. Of course, this country's deal not just with supporting Ukraine, but their own economic outlook. How much can they afford to do as inflation cuts into the cost of living? All that next. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.